My name is Pam Hunter, and I'm a state assembly member from New York, and I'm the chair of the NCOIL Health, Insurance, and Long-Term Care Issues Committee, and I'm moderating this general session this morning. I brought this topic to the attention of the NCOIL leadership several months ago. My son was very interested in Bitcoin and wanted to know more about it and thought that this would be a great session for this body. So this session this morning is Bitcoin and beyond. What is this stuff and how do we insure it? For those who are looking through their binders and can't see where we are, it's the Bitcoin session this morning. We have a great group of panel speakers this morning with us today to discuss this topic, the evolving legislative and regulatory landscape surrounding cryptocurrency. For any of you who watch the stock market, you can now see that they're listing it in trading now as well too. If you are among those in the audience who have heard of cryptocurrency used in the past few years, but may not have heard a good explanation as to what the term actually means, today's panel will not only provide a primer as to what cryptocurrency actually is, but we'll also discuss how different states and countries regulate and insure it. And I said countries because one of our panelists today, Jeff Hansen, is from the UK and will be joining us this morning. As an example of what some state cryptocurrency regulation looks like, in 2015, in my home state, the Department of Financial Services issued virtual currency regulation 23 New York CRR Part 200 under the New York Financial Services Law. Recently, PayPal became the first entity to receive a conditional bit license from the New York Department of Financial Services. I'm interested in learning about what other states and countries have done with their regulation and what the landscape will look like going forward. I know many of my colleagues and others interested in insurance are also interested in hearing about the many insurance implications of the growing cryptocurrency market, with questions like, is it property? What are the different types of insurance coverage available for a cryptocurrency? So today's speakers are Matthew Cohen, Esquire, a senior counsel at Carlton Fields. He is our guest from the UK. Justin Wales, Esquire, senior counsel at Carlton Fields as well. Michael Menapace, Esquire, partner at Wigan and Dana, and Jeff Hansen, executive risk team, Paragon Brokers. I will not read their bios. They are included in your conference program, so please familiarize yourself with them and reach out to them afterwards to learn more about these important issues. This session is scheduled for 1 hour and 15 minutes, and we want to make sure every speaker has the same amount of time and allows for a generous portion for Q&A. So I will be keeping to time, and when you get to a minute, I will be interrupting and letting you know, just so that we can keep this program moving along. So our first speaker joining us this morning is going to be Matthew Cohen. As I mentioned, he is joining us from the UK. So Matthew, if you could kick us off this morning, and just for everyone to keep time, each speaker has 10 minutes. So good morning, Matthew, and we look forward to hearing your comments.
Good morning, everybody. Sorry to disappoint. I'm coming from Miami, Florida, but I could try to do a British accent if that would be entertaining, though I think one of my co-panelists will be delivering on that in just a few moments here. So thank you all for having me. Very excited to be with you. I'm going to go ahead and see if I can't share my screen here. We've got a little presentation for you all. And so hopefully you'll be able to see this. Again, my name is Matt Cohen. I'm an attorney at Carlton Fields. And my colleague Justin, who's here with me, we founded the firm's blockchain practice some time ago. We work with all sorts of companies, companies that are interfacing with blockchain directly, high-tech companies that are developing these protocols, interacting with them, as well as legacy institutional clients, banks, insurance companies who are interested in exploring the technology or have, by circumstance, been forced to understand it or engage with it. So our presentation is going to be quick. Justin and I are splitting the time. So I'm going to give you a brief overview of what blockchain technology is. And Justin's going to tell you a little bit about what we do and summarize the regulations that that apply to it. We're going to ignore a lot of the federal stuff and focus on the state regulations given the audience. And then after everybody on the panel talks, I understand we'll be opening it up for Q&A. So forgive me that I'm going to try to move through some of this material quickly. There's a lot here to go over, but I'm confident that we can get through it all. So what is a blockchain? That's actually a surprisingly difficult question. It depends on what blockchain we're talking about. Throughout this presentation, I'm going to refer to the two most popular ones at the moment, which are Bitcoin and Ethereum. But how we could generally summarize this is a blockchain is a large global ledger. It's basically a database that is distributed amongst hundreds and thousands and millions of different devices throughout the world. Many blockchains are what we call permissionless in the case of Bitcoin and Ethereum. They're open, meaning anybody can access them, anybody can interact with them just by downloading some software. We'll talk in a minute about why blockchains are important, but understand the whole point here of the technology is that this ledger provides a distributed and verifiable way of understanding the data that is in that ledger. So if you look on my screen here, the last bullet point on the left column, it's talking about votes can be verified, moved, stored. A vote, is really just in the case of Bitcoin, it's the Bitcoin blockchain, it's a Bitcoin. In the case of the Ethereum blockchain, it's an Ether. It's whatever the native token or asset of that blockchain is. It can be moved, it can be stored. We can verify who has what and whether anybody is doing anything funny with their balance of Bitcoin or Ether or whatever it is. Trust is an important word in blockchain. The whole point of the blockchain is to remove the need to trust any central intermediary, any single third party, and instead we distribute that trust amongst a bunch of different actors, and we achieve a consensus, is another important word, over what is true. Everybody, for the most part, that interacts with a blockchain protocol has on their device, on their node, as we call it, a copy of the blockchain. So they have all the data. They can see every address. It's pseudonymous, so they don't know who actually owns that address, but they can see all these accounts and understand what the balance of those accounts are. And they can verify if Matt, says he has 1 Bitcoin, he wants to send that 1 Bitcoin to Justin, the blockchain will be able to verify that I in fact have that 1 Bitcoin. And if I send it to Justin, I can't try to double spend it and send it elsewhere. So how does it work? And then we'll talk a bit more about why it matters. A blockchain, again, is this distributed ledger. We're taking this database of inputs, meaning all these accounts and what their balances are, and we're wrapping it in this consensus, meaning we're asking everybody to agree on what the state of this ledger is. We distribute the copies of these ledgers amongst nodes, and we add these transactions into a block. You're probably saying, well, what is a block and what is a blockchain? It's literally just a chain of blocks, and within each block are a series of different transactions. And these transactions are things like Matt sends 1 Bitcoin to Justin, Alice sends 2 Bitcoins to Bob. The nodes, these devices that store the data, reach a consensus. They all agree on what the state of the chain is. They all say, we agree that this is the accurate version and this is not. So anything that happens in this inaccurate version gets ignored or discarded. Miners, on the other hand, you may have heard of Bitcoin mining. Miners are these very powerful computers that crunch numbers and do very complex math to determine if these transactions are indeed valid. So if I want to send 10 Bitcoin to Bob, but I only have 1 Bitcoin to send, a miner would not let that happen. It wouldn't be appended to the chain, and that transaction would be discarded. This is our silly visual representation of what a blockchain looks like. Interesting thing here is each new block has a pointer to the last block in the chain. It's called a hash. It's putting numbers through a mathematical function. That allows us to keep track of everything and ensure that nobody's inserted something nefarious or no one's giving us a copy of something that they shouldn't. Again, we're distributed. We got thousands of devices all over the world. You may know sometimes when, like, for example, Amazon Web Services goes down, it takes half the internet with it. That's not something that generally happens with a blockchain because it is distributed, and you'd have to take down many thousands or millions of devices in order to bring down the network. This picture you're seeing here is one of these miners that we talk about. This is just a very powerful computer that crunches numbers. Nowadays, there's specialized hardware for this sort of thing. But the point is, why do we care about all this? And that's because we have trustworthy transactions among multiple parties without relying on an intermediary. If you think about your bank account, you're reliant on Wells Fargo or Bank of America or whoever to determine that the numbers in your account are real, and that when someone sends you money, it's credited to your account, and when you send money out, it actually goes out. If there was a problem with the bank, who knows, right? That data, I'm sure it's very secure in practice, but any central intermediary is a potential point of failure. The blockchain eliminates that. We don't have to rely on any one party. We can all together achieve consensus on what reality is. I'm going to go ahead and skip this slide and just move over to why it's important so we can get Justin on here to talk a little bit about why we're here. But what are some of the critical features of blockchains that makes it interesting to the marketplace? Well, one reason is we can track the provenance of anything on that blockchain. So if you have a Bitcoin, we can look at that Bitcoin and determine every address it's been to since the moment it came into existence. And so imagine you take that technology, you can replace the Bitcoin with something else. You could replace it with healthcare data, and you can check the provenance of that data, make sure nobody who's looked at it didn't have a right to look at it. You can ensure that you can send it from one place to another. In finance, we have a security settlement, for example. There is a lot of intermediaries between transfer agents and broker dealers, et cetera. And so we can reduce some of that friction by disintermediating these transactions and allowing these settlements to happen peer-to-peer. Of course, we've got other examples, again, given the secure nature of the blockchain and the ability to track the provenance of everything that happens on it. Some have theorized that it could be used to reduce the possibility of voter fraud. And same with, for example, real estate records in places where, unlike the United States, where you can't exactly rely on the county recorder's office, you can track the provenance of a deed electronically through the ledger. You can see here that it's like virtually impossible to mess with the Bitcoin network nefariously. It would take billions of dollars at a cost of millions of dollars per day to continue to attack the network and do nefarious things like spend Bitcoin that you don't have. It'd be really difficult and really expensive for somebody to do it. So again, that was quick, and I hope that was a little bit of a primer, but I don't want to take too much time away from Justin, who's talking about the meat and bones of our regulations here. But I encourage you all to reach out to us after the presentation if you have questions or you want to talk about any of this in more detail. And with that, let me turn it over to Justin for him to fill you all in on what laws are out there and what they do.
Great, and Matt, I'll just cue you up when I need you to change the slide. I appreciate everyone having us, to give this presentation. We both wish we could be there in person and meet you all. I will offer this at the beginning is invariably you're going to have a lot of questions about how does Bitcoin work? Why, for instance, how is it is it secure as an underlying asset? How are different states taking these different approaches? I would say, and in the same way that I would have stayed after a conference in person, send Matt or I an email, call us up. We'd love to meet you. We'd love to talk through these issues with you because it's much more complicated than I think a lot of people realize going in. As Matt sort of described, if you can go back to the last page, Matt. As Matt described, it's a complicated piece of technology, and one of the things that overcomplicates it in terms of how regulators have approached dealing with it is that it's not just one piece of technology. The blockchain is a distributed ledger, but you can build all sorts of different types of applications and use cases on blockchains. Now, typically, the way we hear about it is Bitcoin is trading, right now it's trading at about $19,000 a coin. To give you some perspective, it was about $4,000 in March. And in 2010, it was trading for a fraction of a penny. So you hear stories about people making incredible sums of money from very small investments because the market is growing at such a high rate. JP Morgan just the other day said it's an alternative asset to gold that will actually take some of gold's asset supply. So you're seeing regulators coming from, we need to regulate this as an investment. And that is even exasperated by the fact that there are lots of other different types of tokens that are traded that have different use cases, but they're traded on an open market, but typically seen by the public as investments. So one of the things you're seeing at a federal side is really a focus on how is this being used as investments? How are these currencies being used for funding nefarious activities? How do we ensure that the on-ramps to these public networks are complying with BSA requirements, AML, KYC, and that's pretty consistent on a federal level. There's a lot of securities issues that they're dealing with in terms of at what point does the sale of a native token become an investment contract. The CFTC typically deals with open ledgers like Bitcoin, which has a native token that is a security. The IRS looks at these things like property, and you have to pay capital gains, even if it's used as a money. And FinCEN has given us a lot of guidance. But what we want to talk about really is the state regulation. Matt, if you can go to the next page. And the state regulations are sort of a mess. We'll just show you as an example. This picture is about maybe a year old, so it's not completely up to date. But it gives you an example of some of the different approaches that states have taken in terms of applying, just for instance, money transmission rules. So the question is whether a cryptocurrency is or is not a money, such that those dealing with those cryptocurrencies need to apply for a money transmitter license where one is applicable in the state. And from a federal level, pretty much it's pretty broad that if you're dealing with virtual currencies as a transmitter, you need to apply for a money service business license with FinCEN. But in the states have taken a very different approach. So just to give you two examples, New York has a bit license regime through the Department of Financial Services. Now, I think at the beginning, Pamela said that there was PayPal just was issued a conditional license. The conditional license program is a pretty new thing and came as a result of when the bit license was first enacted. It was just a very difficult, very expensive, very long, arduous license to obtain. So the state of New York has actually made it a little marginally easier by creating a conditional license. But New York has really taken the most aggressive approach to at what point do you need a license to operate with virtual currency? And really, New York has taken the position that in almost every instance where you are a business interacting with a virtual currency as very broadly defined, you'll need a license. On the other side is Wyoming, which has really tried to position itself as a very, very crypto-friendly space. So they've actually exempted a lot of tokens from their securities laws. They've said that virtual currencies are not money when it comes to money transmitter rules. And then there's everything in between. Now, one of the challenges that we have, and we deal with, many of these states, but both, their Department of Financial Services, as well as their securities agencies, as well as their criminal, prosecutors, as well as securities agencies. Just we're dealing with a lot of different agencies within the same jurisdiction. And what you sometimes see happening is that different agencies within a state take very different positions on whether, for instance, Bitcoin is money or is not money and is property. Whether basically something is a security or whether it's a commodity is really not very clear in an aggregate level, because virtual currencies and Bitcoin, Ethereum, all these other different examples are used for very different things by very different people for very different purposes. So one of the problems that we see happening quite a lot, and Matt and I actually write Thomson Reuter's treatise on state regulations of virtual currencies, is you typically see, okay, we want to regulate crypto. So we're going to pass a really broad regulation on virtual currencies without any of the nuance of, well, what type of blockchain are we talking about? Is it public or is it private? what type of underlying use does the crypto have? Is it merely to hold value and to transact value like Bitcoin? Does it have an underlying purpose like Ethereum, where you can build actually decentralized applications, put smart contracts on the network that sort of apply to many different areas? And that's one of the issues that we have with crypto regulation generally, is that we speak about it as, well, Bitcoin blockchain, but it's really much broader technology. It's almost like saying, what is the internet used for? Well, the internet's used for email. So if I want to create a regulation, I'm going to say, well, I want to regulate email. And then we call that an internet regulation. But the internet is actually used for many, many more things than email, including us giving this presentation now and everything you can imagine happening in commerce throughout the world. So that's really sort of the challenge that we have with regulating cryptocurrency broadly. To give you some other examples of the types of regulation you see happening, is you have, like I said, typically the most common type of regulation is dealing with money transmitter rules, but you also see bespoke regulation. For instance, Delaware allows you to issue corporate stock certificates on the blockchain. You see a lot of banking regulations within the state updated to include money transmitter, to include virtual currency applications. Wyoming has really led the charge with regard to those types of regulations. One of the things that I think we'll do is we'll send to the conference a copy of our treatise, which goes through all 50 states and gives you, as of I think about 3 months ago was the last time we updated it, examples of the types of regulations that have been passed, including ones that have been proposed and maybe didn't actually make it through. But I want to be mindful of the other presenters' times and save time for questions. So I'll hand it back over to Pamela.
Thank you so much, Matthew and Justin. And for all of you listening this morning, we are doing our Bitcoin session. And you don't have to raise your hand, but I'm wondering how many of you are still with us, wondering what is a block and a node, and if you're familiar, and do you feel like what they're talking about is a different language? So most of you are not on video, so I don't know if you're shaking your head yes or just wondering underneath, but this is very interesting, and this is something that you're hearing on our financial news all of the time, so this is absolutely timely. Our next speaker is Michael Menepes. Hopefully I'm pronouncing your name correctly, and you're up next, sir.
Unmute myself here. Thank you. Good morning, everyone.
Good morning.
And hopefully you can see my screen. Pamela, can you see the
Yes.
blue screen that I just shared? Terrific. So what I'd like to talk about today is some intersection between what the guys were just talking about and the insurance arena. And so I'm going to amplify some of the concepts that the guys were talking about, but we're going to take a slightly different tact because the regulation and the insurance aspects, while there certainly is some overlap, there are some differences. But I think that what we talk about will also help folks get an idea of some of the very basic concepts that we need to wrestle with when we're talking about cryptocurrency. And for us mere mortals, unlike Justin and Matt, who live with this stuff every day and understand it, I completely understand that this is a conceptually difficult issue to wrap our head around. And so what I'd like to do is simplify it down to some very basic questions. And so I'm going to do that with some examples. So back in the day, like 10 years ago, not that long ago, there was a spate of piracy incidents in the Strait of Hormuz, and we had Somali pirates going after ships and boarding them and holding them for ransom. And what would happen was the pirates would board their little boat with heavy armaments, and they would go out and find the big tankers. They would board them. They would have the pilot of the boat sail them to a friendly place for them. And then they would hold the boat and the crew for ransom, and insurers would then pay the ransom by literally dropping pallets of cash at a specified location or coordinates. So this is the way it used to be. Well, more recently, the pirates have they have started developing different tools. So instead of going out and finding the boats, for example, they now hack into the GPS system. So the pilot thinks he's steering the boat where he wants to go, but really what he's doing is steering the boat directly to the pirates, and the pirates can board it much easier rather than going out to the open ocean. The other thing that's happened is the pirates are not asking for cash now. All of the ransom we pay now is in Bitcoin. But let me just tell you, we don't need to be this exotic to start talking about how the insurance aspects have evolved. Because, let me give you just another example. Every ransomware incident that we now respond to is paid in Bitcoin. So every time one of my firm's clients, their computer system gets seized up because of ransomware, the ransom gets paid in Bitcoin. Our IT vendors who help us with this already have wallets set up so that they can pay the ransom, the bad guys, and then they get reimbursed by the clients or the insurance companies. But we can even be less exotic than this. And this is where I'd like to take us, because it boils some things down to a very basic level. If you're like me, you go to the grocery store, and we've all seen these Coinstar machines in the grocery store, right? These are the places where we take our bucket of coins, we dump it in there, and we come out with paper money, and Coinstar is happy to charge us 6-7% to do this. But I noticed something really interesting recently at a local store, and it was this. So take a look at the Coinstar machine on the right. I'm going to give a little close-up. You can now buy Bitcoin at the grocery store at one of these Coinstar machines. And a study about a year and a half ago, a survey determined that about 10% of Americans, these are individuals, have invested in some type of cryptocurrency. That's certainly bigger now than the year and a half ago, and certainly that's going to grow. So individuals, our fellow citizens, are obtaining cryptocurrency for themselves. So let's talk about what that means, because this isn't just about the dark web anymore. This is real people are investing in this and holding this. So when you and I have money in the bank, it's insured by FDIC. Or if we have assets with Vanguard, my retirement account, Vanguard is responsible for holding those assets, and I presume they're insured for those in case something happens. But for assets held at home, for the individuals who are holding Bitcoin, the question is there insurance for this? Now, the most common type of personal lines of insurance, of course, is homeowners for property. Auto, but that's certainly not relevant here. So homeowners insurance. So if a thief breaks into my house and steals my television, I have homeowners insurance. If my home burns down, I have homeowners insurance. The insurance covers this. But how is my cryptocurrency being held if I hold it? Right? So it's a very different question. So you might ask, if an individual loses their cryptocurrency, and we're going to talk about this for the next couple of minutes, is the owner of that cryptocurrency insured under their homeowner's policy if a thief hacks into their computer and steals their virtual currency or the currency key, the equivalent of it? Or let's say I'm keeping my cryptocurrency and its key on a flash drive at my home. And let's say that flash drive is stolen or it burns in a fire. Okay? Just like the television example I gave you before. Is it insured under my homeowner's policy? Well, like any good lawyer, I'm going to give you the answer of it depends. And what does it depend upon? And this is how we're going to get to the next step here. So part of this answer, however, talks about what Justin was just talking about. What is the cryptocurrency? Well, the SEC takes the position that cryptocurrency is, or at least can be, a security, and cautions that issuers of the virtual currency can't avoid the federal security laws just by labeling their product a cryptocurrency or a digital token. On the other hand, a different federal agency, the IRS, under a notice 2014-21, has identified cryptocurrency as property for federal income tax purposes. So on one hand, we have the SEC saying it's a security. We have the IRS taking the position that, at least for some purposes, it's property. Third possibility is that cryptocurrency, certainly which can be used to purchase goods in the case of Bitcoin and others, and services, is more properly classified as money. Or is it something else? And then I'll throw the complicating factor in there of, does it have to be one thing for all of these purposes? Another, can it be different things for different purposes? So, so we need to think about what the meaning of and what it is when we start talking about the insurance policies. And I will say there is no reason why it has to be treated as the same thing for different purposes. Therefore, the pronouncements of the SEC and the IRS are really only of limited assistance when we start talking about the insurance issues. So let's dive in. The homeowner's policy. What does it cover? Well, it covers the loss of an insured's dwelling, other structures, and personal property. Well, clearly, cryptocurrency is not a dwelling or a structure. So we're really looking at, do current homeowners policies cover cryptocurrency as property in the general sense? Because we often protect against this loss of property. But we can't just stop there and say, whatever it is, it's some sort of property. Well, that's not good enough for the insurance aspects. Okay? So because even if cryptocurrency is property in a general way under an insurance contract, the analysis doesn't end there, because not all property is treated equally under a homeowner's policy, right? So for example, loss of personal property often has a $200 sublimit if the property is money or banknotes or gold, coins, store cards, cash cards. Or homeowner's policy has a different sublimit, often $1,500 for personal property that is securities or letters of credit or banknotes or tickets and stamps. So when we consider what kind of property is, we need to consider these sublimits. If it's just property generally and not one of those specific things, then the only limits are the policy limits. And I could have policy limits under your homeowner's policy of hundreds of thousands of dollars. So it makes a difference as to what we call these things. Okay. So at least for some cryptocurrencies like Bitcoin, an analogy to money seems more appropriate because Bitcoin is specifically designed to be an alternative to traditional currency. So in that sense, treating Bitcoin like a security certainly doesn't make sense. When we think of a security, when we own a share of stock in some company, the comparisons to Bitcoin are pretty thin. But Ethereum, as the guys were saying, was created for a completely different purpose than Bitcoin. And while it does have value associated with coins and tokens, its original purpose was very different. It's a platform where we can build out other applications. So in that sense, does money make sense? So we really need to understand not only cryptocurrency, as a whole, but we need to understand the various components before we start regulating how it's treated under an insurance policy, because insurance policies don't define it. We have no idea how cryptocurrency is treated under the standard homeowners policy. I called a number of my clients, and I won't mention names, and I asked them about this, and they said, yeah, we know this is an issue, but we haven't changed our policies, and we really don't have a stated position on how cryptocurrency is treated under our homeowners policies. Now, I will say that commercial insurance policies are treated a little differently. They're a little ahead of this, and we're going to hear about that in a minute. But with the case of personal lines, who is now going to make this decision about how cryptocurrencies are treated? Well, if it's not in the policy, and we don't have any laws on it yet, at least for insurance and how it's treated, it's going to go to judges. And at least there's one case out of an Ohio trial court case where the judge did decide, he had to decide what cryptocurrency was. And So let's take a look at it. It's the Kimmelman case. Cryptocurrency after this case was defined as generic property. It wasn't defined as money, and therefore the $200 sublimit didn't apply, which means there were no limits other than the overall policy limits for the cryptocurrency. Now, I'm going to suggest that this case was wrongly decided, or at least of limited value. The Ohio court didn't provide a real fulsome analysis of this, understandably. It was a small case, small amount at issue. It really wasn't litigated fully. But one of the other examples, the judge didn't have to wrestle with sublimits for electronic funds versus securities. In addition, the policy the judge was looking at was a policy drafted in 1999, years before cryptocurrencies were invented. And so, I question whether the language of the newer policies that we're dealing with today, really will get much traction or much influence from this case. But the judge did rely pretty heavily on the IRS guidance mentioned above. But as we know, the IRS guidance says that the cryptocurrency is treated for property for income tax purposes, not necessarily for insurance purposes. So we have to deal with that. So moving on, the court was also persuaded that Bitcoin was general property and not money because it could be exchanged for money. It's a convertible virtual currency, but that doesn't really wash with me. Certainly, we exchange euros into dollars all the time, and indeed, Bitcoin was originally conceived as a currency akin to cash. So, I'm not sure that that his rationale for that really makes sense. As Pamela said, we certainly the markets and the Wall Street Journal report Bitcoin under currency values when they report them. And no one would argue, for example, that the yen, which is also reported in there, is property, like the judge decided the Bitcoin was. So where does this leave us? Well, the bottom line is, for the moment, homeowners, us all, should not rely on our homeowners policies to protect us for the loss of currencies. Okay, commercial entities, in contrast, they can buy crime policies and other policies, and individuals should hold their currency, their cryptocurrency, with these commercial entities. Okay, so that's just for the moment. But we do need to figure this out. Do we really want judges making these decisions? And this is the question I have for you all. And I would say the answer is no. And the judges will probably agree. We don't want the judges trying to wrestle with these things. Okay? The cases are too fact dependent. Depends on what kind of crypto, how is it stored, who owns it, how is it lost and destroyed. Lawsuits are long and costly. Instead, I say, homeowners insurers and other personal lines insurers should address this issue head on and define what cryptocurrency is and how it will be treated in the policy itself. And insurance regulators should start talking with their insurance company clients to figure out how are we going to define and deal with this before it gets kicked to some judge who's sitting there like Solomon and having to make these pronouncements. I would also say, as another alternative to that, that it's up to legislators to define how are we going to treat cryptocurrency in the insurance context. What is it? Is it property? Is it money? Is it something else? Okay? And these kind of deliberative decisions are really best made by legislators and the insurance regulators, because they can consider the policy language. They can consider over longer periods of time, is this really the coverage we want? And they can debate these risks and whether they're insurable. And are we incentivizing the right kind of behavior? Are we avoiding moral hazard? Okay. Are we really incentivizing individuals that instead of keeping it in a flash drive at home, are we incentivizing them to keeping it someplace more secure that's trackable? And we don't have to wrestle with some of these issues. We can wrestle with whether we should insure it, for how much, what do we deal with the great fluctuations, and how does that get treated under the insurance? But these are really public policy questions that legislators and regulators should really be dealing with the insurance companies, rather than waiting for disputes to happen and kicking it over to judges to make decisions somewhat in the vacuum. And today's presentation, by the guys earlier and what we're talking about now, really is the first step for all of us to understand what this is and what the implications are, so we can start having these conversations and making well-informed public policy decisions.
Thank you,
So
Michael.
I will take it there, and I'll pass it over, and we can talk more about it later on.
Thank you so much. Next up, we have Jeff Hansen.
Okay, I'm gonna stop my sharing. Hold on. There we go.
And for anyone with a question, if you could please utilize the raise hand function, and as soon as Mr. Hansen's presentation is over, we can go to questions. Thank you. Mr. Hansen?
Okay, can you see my slides
Yes.
in front of you, Karen? Wonderful.
Yes.
Firstly, I'd just like an apology, if I may, just in case. I've actually just been diagnosed with COVID, so if my voice goes and I have to take a break, please excuse me, but I'll pass along if I may. Just as some background, really. I work in the London insurance market for a Lloyd's broker. I've been placing financial lines business for 30 years, but got into crypto around about 2013, which was, I think, the first time so the crypto firms came to London to look at insurance. And I think that kind of leads me nicely into the next slide. So when those firms came to us back in the day, and these are obviously commercial firms, mostly custodians and exchanges. I think some of the kind of names you'll be familiar with will be Coinbase, BitGo, possibly Genesis, kind of some of the big names in North America right now. They came to London originally, concerns around obviously reputation with Silk Road, everything that was going on there. Obviously you've got FDIC protection on your fiat currency, that they were looking at some kind of insurance solution to give clients basically some kind of protection, albeit by insurance. And then I think the third thing at that time was obviously client comfort, and just the fact that there was some kind of protection and risk transfer mechanism in place. I think we got into early 2014, and then kind of Mt. Gox kind of became very apparent as to kind of what could happen with these hacks. And I think at the time, $460 million was quite a significant number. Potentially $7.5 billion of assets have been stolen. And again, more to kind of demonstrate why these custodians are required. Approximately 20% of all Bitcoin have actually been stolen or lost. And there's some kind of spectacular stories about how some people have lost their crypto, kind of keeping data under pillows and things like that. It's quite spectacular. This is kind of one of the criteria around how the insurers in London generally underwrite, and this is very key, just how the coins are stored. Most of the hacks that we see are actually hot wallet losses, so these are where the private key data is stored online. And it's effectively in one place. It can be hacked into and penetrated and stolen. Wall kind of breaks that down into different servers or into different places. And there are kind of key management companies such as BitGo, where they will hold part of your private key data for you. And then finally Cold, which is obviously much more secure and safe. It's completely offline and air-gapped, and is more of a physical issue as opposed to kind of an online hack. So the main coverage that we're placing right now, historically, is a derivative from just a general commercial crime product. It covers all the kind of usual things: employee theft, premises transit, third-party computer, funds transfer, and some legal costs. We've had to make some very specific changes to that product, really around, again, the definition of property, and to make sure that we're picking up the private key data associated with the asset. That's the real kind of key driver to make this product work. We've had to be quite careful around the base of valuation and how that operates to avoid some of that kind of moral hazard issue. And I think obviously with a blockchain, if it was stolen from the blockchain, you can see exactly when that was stolen. So obviously that was kind of one of the drivers around how that would operate, and I'll make it very clear. And there's a couple of other bits in there, such as, I think, a key exclusion that the market wanted to add was obviously if there was if effectively the blockchain protocol failed, there wouldn't be a loss under the policy. But fundamentally, it's a crime type of product. Again, this product would cover your traditional crime exposure, so it does cover your fiat currency as well. We have in London placed crime programs in excess of 100 million. That is for hot, warm and cold stored assets. And there are several kind of in that kind of range now. It's not ideal as far as a lot of these custodians are concerned, because they're holding significantly more than that in this environment, particularly with the values at the moment. So that's been a bit of a challenge, and that's kind of where we'll come onto the specie market in a second. Again, hot and warm storage, it's just that more difficult to get insured. There is a process to go through, but again, most of the hacks you see, or in fact, all of the hacks I've seen, have come from hot wallets. Again, I mentioned at the start that there was this kind of reputational requirement, and these firms wanting some recognition and branding. Unfortunately, a few people did actually kind of, without permission, say they had Lloyd's sign off and they had a Lloyd's policy, which you cannot do without their express permission, and some of those policies were cancelled. It caused a few issues in 14 when I think the Lloyd's regulator came down on them and said, look, why are you kind of insuring these unregulated entities, and what's going on? So with the likes of Coinbase and some of the other large custodians at the time, we spent most of 2014 educating Lloyd's and their kind of hierarchy as to kind of what was going on, what they're trying to do, and kind of make the point that these firms are trying to become regulated. They want to be seen as credible financial services firms. And finally, at the start of last year, we actually got Lloyd's comfortable with kind of what we were doing, to the point where they actually endorsed a couple of products that have been placed in the market. So it's a big positive back in February of last year. So specie cover. So I mentioned that there's about $100 million of cover for anyone insured. Again, doesn't really touch the sides. The thing with the specie market, and I kind of touched on it here, historically, the specie market is more about kind of fine art, jewelry, cash, but those kind of physical assets, whether that's in transit or in vaults and so on. So we spoke to those markets and basically got some of them to agree that if the private key data was held in physical media in secure locations, that they would entertain providing some insurance. We got to somewhere in the region of about $500 million of capacity. I think that's slowly creeping nearer towards $1 billion. Obviously, because it's only the cold storage and the physical element, we have got some more capacity to do that. Obviously, that has an impact on the price. And I think we'll kind of talk about this later on, but with regulation now, I think most of these firms are looking to put as much where they possibly can into cold. So it does give that opportunity for customers to buy some kind of dedicated insurance. The next point there, I've mentioned that these custodians can buy dedicated insurance for specific customers, or they can buy a socialised limit for all customers, or a mixture of the two. And certainly as these firms are growing, you don't necessarily want to go out and buy $500 million of insurance and pay for that up front. So we've come up with some kind of ways of effectively a pay-as-you-go. So you pay a deposit premium, you lock in 50 million maybe, and that gives you scalability up to potentially up to kind of $500 million. Again, a benefit of the specie policy, you can apply ground up. We've seen a real mix of ground up policies with the crime sitting above or alongside where there's more relevant cover, and we've seen specie applying in excess of the crime policy. But it's a real mix and match. It just kind of depends on your storage method and your preference. But there's kind of a lot of flexibility in how that would sit. So underwriting criteria. Basically, there's we've got a format of documentation that we've worked on over the last kind of 6 or 7 years, but the basics are here. It's kind of who you are, what you do, who you do it for, and where. Basic kind of information that you'd get from their investor decks. What's quite an interesting one is their onboarding of assets and which assets. I think the general criteria as far as the market's concerned is it has to meet the same kind of criteria as a blockchain, as Bitcoin, effectively. The market are generally uncomfortable about assets that aren't traded commonly. Again, it's just kind of how you value that asset. And also there's some concerns around privacy coins. And that kind of comes on to KYC AML. again, when Lloyd shut their doors back in 2014 and basically worked with us and some other brokers to open the doors up again, we looked at kind of some of the key issues, and KYC, AML sanctions were really kind of drivers, just more reputationally than from a risk perspective. So that kind of segued into kind of an onboarding process where the market are quite, that they have to have something very clear in place about what coins you're using, who you're providing those coins to, and I think that, sorry, I'm going around in circles, sorry, apologies. Onboarding, so again, KYC, AML, who are your clients, sanctioned territories come into play, and then obviously that kind of transaction process. So how do you verify that Bob is in fact Bob when he's asking for his asset to come off of your platform? And that's as important, particularly with kind of cold storage. I don't think realistically these firms see they're going to have a cold storage loss. I think the bigger threat, in our opinion, is hot wallets, and just verifying who's actually asking for those coins back. And then kind of the real you get into the real nuts and bolts, the actual security, hot, warm, cold, and then you have to get into a lot of detail around how you're storing the coins. Most of these assets are sharded, and they break down the private key data into various different parts and store that data in different geographically spread secure locations. And that's quite key, and the market like to see that. I've made a comment on here, must demonstrate care, custody and control. There are some solutions out there. As an example, I've got one there, MPC, which is multi-party computation. It's a variation on this kind of sharding process. And one of the issues that we've had in getting insurance for that is that no one ultimately has care, custody and control, or in a lot of the circumstances may not. So this is something that the market are quite keen to make sure exists, that they do actually have control. Again, we come to the backup keys and Cs. Obviously, the market wants to make sure that you may have gone through all the process of securing the private key data, but you haven't got a backup sitting in your kind of top drawer. So again, they would expect a similar kind of protection, again, segregated from the other assets. And obviously, business continuity planning is relevant. As far as other lines of insurance, when you get into the liabilities, it becomes a little bit more difficult, partly because of the legislation or lack of regulation and just ambiguity globally on this. We've seen obviously a lot of need for directors and officers liability insurance, obviously for the main reasons why you would want that insurance. But what we're also seeing is to attract talent to the board, particularly if you're trying to attract talent from a large Wall Street institution. They want a certain degree of protection under a D&O policy. So for these firms where they're buying $1 million and they're used to having $300 million with a Wall Street bank, there's obviously a need and a greater need for directors and officers liability insurance. It's a very limited market, even compared to the crime, and it can be extremely expensive. As far as the professional liability is concerned, we've not seen, as far as traditional FI is concerned, there's not a huge degree of appetite for it at the moment. We've seen it on a few state-by-state basis or cases where I think certain states, I can't recall which, maybe Indiana, where there was a requirement for NCOIL purposes that they needed to buy some form of professional liability, but we haven't really seen a great deal of take-up on PI at the moment. The tech and the cyber, again, there's a relatively small market for it. It's quite expensive, so we haven't seen a huge amount of take-up on that just yet. Now, I'll kind of zip through that relatively quickly, but that's my presentation.
Thank you so much, and I really appreciate you working with us this morning, especially having COVID. I know it's affecting obviously so many people, so I really appreciate you participating this morning.
No problem at all.
So before we open up for questions, I actually have a few questions myself, and this is for anyone. Again, if you have a question, if you could kindly use the hand raise function for the legislators who are currently on. Please use the hand raise function. I can, see your little blue hands raised with the icon, and I will get to you in order. So I know this might sound, all of these questions I have may sound very naive, and but that's okay because I have, really no experience with this. But I believe it was Michael or Matthew, excuse me, who had spoken about the blockchain and knowing who owns each one. So I'm just trying to figure out, how can it get stolen from pirates if we know who owns each block and where each account and ledger comes from? That I didn't understand that.
That's a great question. So the simple answer to your question is that in the case of Bitcoin, it is pseudonymous, meaning it's not entirely anonymous, but it's also not entirely identifiable. And so when we say that we can check the provenance of any Bitcoin and understand where it goes, what we mean by that is we can trace it from one address to another. In the case of Bitcoin, each private key, that's the thing that Jeff was talking about ensuring. That's the long string of letters and numbers that determines who owns what Bitcoin. From that private key, we derive public keys. That is your forward-facing address, if you will. And that's, again, sort of a complex string of letters and numbers. It doesn't correspond to my name necessarily, doesn't correspond to an address. It just corresponds to a private key. We're talking about hash functions here and putting data in and getting data out. So when we say we can trace Bitcoin, what we mean is we can trace it from one address to another fairly easily. That traces it to the public addresses. We can, the whole premise of elliptic curve cryptography, which is what drives cryptocurrency, is that it only goes in one direction. You can get a permutation from private key to public key, but you cannot look at a public key and derive what the private key is. So the thing that gives you ownership, what gives me ownership of my Bitcoin, is that I have a private key somewhere. And because nobody can trace the public key and take that public key and ensure that it corresponds to my private key, it's pseudonymous. I know which address it came from. I don't necessarily know whose address that was. Now, it's a little bit different in reality, right? Because at some point, most people want to turn that Bitcoin into fiat currency somewhere in order to get the proceeds of, in the case of the piracy, their ill-gotten gains. And in order to do that, you've got to sign up for a central intermediary of an exchange or some service that will exchange those Bitcoins for some other asset like fiat currency. Those central intermediaries are typically going to be subject to the Bank Secrecy Act and all the different know your customer and anti-money laundering laws. So when law enforcement is looking to redress a wrong in connection with piracy, they'll often look to determine whether those Bitcoins went to a public address associated with an exchange. And if that's the case, they can subpoena the records from that exchange to determine whose identity is behind that address. So there's a couple steps to it. It's pseudonymous, not anonymous, and it's not perfectly identifiable. But what's important to know from a legislator's point of view is cryptocurrencies are actually horrendous money laundering tools. If you want to get caught, use Bitcoin to launder your money. Cash is way more effective. So if your concern here in regulating this stuff is around the money laundering and know your customer, that's not necessarily where you need to be thinking, if I could be so bold to posit, because the very features of the blockchain allows us to track this provenance, and the practical uses allow us to fairly easily trace to where these things go in the event of a nefarious activity.
Okay, thank you. Representative Jim Gooch from Kentucky had his hand raised for a question.
Thank you, Madam Chair. You actually asked the question that I wanted to ask. So thank you.
Okay. Can you or someone tell me, so we talked about Bitcoin and we just kind of went over very quickly Ethereum. There's other ones out there, and a lot of this came from the dark web, so can someone maybe talk about a few of the other cryptocurrencies that are out there and what they're used for?
Yeah, maybe I can take this one. So we talked about Bitcoin being primarily an electronic cash system. The original white paper pitched it as an electronic cash system. one of the issues that Matt raised with Bitcoin is because you can trace every transaction, a lot of people within the crypto community think, well, there should have been some privacy feature built into Bitcoin to make it actually harder to trace, because a lot of the crypto, sort of mindset is we want to take the monetary functions away from central banks. We want to ensure financial privacy. So you've seen other types of cryptocurrencies. Monero is one, Zcash is another, Dash is another one that prioritize privacy. So it makes it actually harder to trace the provenance of Bitcoin, or I'm sorry, of that cryptocurrency. Another example is Ethereum, which allows is a network that allows you to run programmatic applications. Sometimes they're called smart contracts. That those smart contracts themselves can sometimes require an additional native token. So if you remember from maybe 3 years ago, you were aware there was a big run up in the price of crypto generally. A lot of that was based on the market for new native tokens issued through something called an initial coin offering. And each of those native tokens were basically used as purported to use. There was a lot of sort of nefarious activity, but in the best case, they were going to be used as utility tokens to run decentralized networks that would do all sorts of different types of functions across every different type of industry. On top of that, you are now starting to see different types of tokens that are security tokens, which are specifically tied, basically tokenizing assets such as stock certificates. They are used as basically the provenance. They're tokenizing a physical or a digital piece of art. So, they represent ownership of something in either the real or virtual world. So these are different types of tokens. Some tokens are called non-fungible tokens, meaning that they are not fungible. You can't just trade them one for one, but they represent some, unique, asset, and they're being traded using the efficiencies of a blockchain without actually, being put on sort of the same type of public market that you see Bitcoin and these other cryptocurrencies. So these are just some examples, but there are many others, and that's one of the issues that we have when Matt and I speak to regulators, both on the insurance side, but also on the financial regulation side, is trying to explain it's much more nuanced and much more complicated than you would think, and helping them try to understand how to draft language to focus in on what they want to regulate and not regulate things that they maybe don't intend to.
Thanks. I just have one last question, and I want to make sure if any of my legislative colleagues have questions, they need to, raise their hand so that they can get them in, because we're coming close to our time to wrap it up. So I have 19,000 Bitcoins, and I want to cash them out. To whom do I cash it out, and how much does it equal in dollars if it is currency, or is it not cash outable like an investment?
Yeah, so a couple things just about the Bitcoin market. So if you have 19,000 Bitcoins, you're not working anymore. You're on a private island. Every Bitcoin is worth $19,000 today. And it's important to realize that you can subdivide that Bitcoin and purchase that Bitcoin in up to 8 decimal points. The smallest value, 0.00000001, is called a Satoshi. So it's an incredible fungible market for Bitcoin. You would be able to cash out through one of these, private exchanges, Coinbase, Gemini. There are several. And basically any amount of money. Just the other day, for instance, I was reading there was $165 million in Bitcoin sold at, I think, $1.35 network fee, instantaneously, right? So it's atomic. There's not a liquidity problem in Bitcoin. When you get to other types of cryptocurrency, especially ones that we would typically call, ICO tokens, where there's a much smaller market share, or that market share is typically mostly held by the proprietors who are issuing those tokens. At that point, it becomes a little more difficult to exit out of the token without one making a dent in the price if you're really a big bag holder, or to try to get all your entire investment out. But for Bitcoin, there wouldn't be a problem. You just go through one of these exchanges that are, they're unicorns. They're all going to be valued at over $1 billion and are pretty well regulated.
Well, everyone loves unicorns, so I appreciate that. Thank you. I don't see any hand raise function. Will, if Will is out there, we're at 11:21. We're scheduled till 11:30. Are we good to close out if there are no questions from my colleagues?
No questions here.
Okay, very good. Well, I appreciate all of you who are joining today virtually. This was very informative. For those who didn't ask any questions, I see Michael did put something in the chat letting folks know who weren't courageous like me, perhaps, to ask naive questions, that you could go to a website he put out there that does give basic information on the different types of cryptocurrency. And I suspect that, as I said on the Financial Service Committee with NCOIL as well, that this is going to be an ongoing conversation, that we have going forward. We all represent from various states, and per the map that they showed, we're all doing something a little bit differently. So I suspect this is going to be a huge ongoing conversation. So I appreciate everyone's time this morning. Be well, and we'll see you at our next sessions. Thank you.
So I want to go ahead and call to order the Joint State and Federal Relations and International Insurance Committee. And first call to order is, I'm going to ask the legislators on Zoom to identify themselves. I'm State Senator Bob Hackett from Ohio and chair of the committee. So just jump in and introduce yourselves if you're on Zoom.
Ken Cooley in California. Good morning.
Good morning, sir.
Pam Hunter, New York.
That was a great session you just had. That was great.
Thank you so much.
Kevin Cahill in New York. George Kaiser, North Dakota.
George. So I think that's it as of now. There'll be people coming on. How about now for the legislators that are there in Tampa? Will they announce themselves?
Representative Lehman, Matt Lehman.
Yeah.
State Senator Andy Zay, Indiana.
State Senator Mike Gaskell, Indiana.
Welcome, Mike.
Senator Paul Etke, Minnesota.
Can I have a motion now to waive the quorum?
So moved.
Waive the
Okay,
quorum.
it's been moved. Can I have a second?
Second.
Okay, have a second. All in favor, please say aye.
Aye.
Aye. Opposed, nay, but we're okay. Next order of business is, I need a motion to adopt the September 24th meeting minutes. If you just look them over real quick, they're in your book. If there are any questions, any additions or changes, please let me know. Let me have a motion.
So move.
Have a move. Can I have a second?
Second.
Yeah, all in favor, please say aye.
Aye.
Opposed, nay. Motion carries. Okay, our first order of business today is we're going to have the update on the pandemic business interruption coverage proposals. And the first one that I have slated to speak is Deidre Manna, Senior VP, Head of Government and Industrial Affairs at Zurich, North America. Deidre. Deidre, are you online?
I am here, Chairman Hackett. Thank you.
Welcome. Turn it over to you.
Well, good morning, everyone. And thank you, Chairman Hackett. And I wish we were all in the same room, but I still want to thank you for the opportunity to present today. So Zurich North America, just a little bit about us quickly, is we're one of the top 5 commercial property casualty writers in the US. We have 9,000 employees in the United States and 3,000 at our headquarters in Schaumburg, Illinois, which is right outside of Chicago. We're one of the top writers in the construction area, as well as one of the top writers in the auto space. So today I wanted to have 2 purposes. One is to provide the committee on an update on the proposals that are out there to deal with prospective pandemics, as well as the timing. And then I've been joined by my colleague, Pete Caminiti, who is Zurich North America's head of technical underwriting for property. And he's going to walk us through, including slides, Zurich's concept. But before we get to that, I wanted to provide an update on what is going on in the space of dealing with the prospective pandemics from an insurance perspective. As everyone knows, there's several proposals out there, and you've heard from some of them. We do have a chart that we can share that outlines each of the proposal and does a side-by-side. We can share that during the Q&A or at any point that anyone's interested. So first, if you recall, at the very beginning of the pandemic, when this first started, Marsh came out with some ideas early on, and we are going to have Congressman Maloney present after us. She'll be here in about 20 minutes to talk about what she did with that proposal. And it's called PRIA, the Pandemic Risk Insurance Act. So I'll defer to her to inform everybody on the status of that and the timing. I believe Chubb testified recently to this group on 2 of their proposals that they have out there. And then the APCI and NAMIC have what's called the BCPP, the Business Continuity Pandemic Proposal. And in their proposal, outside of the distribution, insurers do not have a role to play. The policyholder community, which is our customers, and it's been led by Charlie Landgraf, has also presented to this committee on their ideas. So all of these are out there, but we're obviously looking at the next Congress and how they're going to deal with this. As we're seeing the beginning of the end, we could see some activities, and we know the discussions are going to continue in the next Congress. While the timing isn't clear, we do believe that even as soon as January, we'll start to talk about legislation. So now turning to Zurich's concept, and I use the word concept, and I use the word concept on purpose, because we don't view ours as a competing proposal. We wanted to bring ideas to the table and bring ideas to the discussion on how to deal with prospective pandemics for our customers. So our CEO, Kathleen Savio, recognized early on that the federal crop program could be used as a model to look at future pandemics. Zurich's the 2nd largest crop writer in the United States, and we saw merit in that concept. So we put our underwriters, our strategy, our crop people, our risk, and our claims. We got them together. This hasn't been created by lobbyists. This is created by our business people. And let me, as we start to present it, before I kick it over to Pete, let me just say that Zurich is completely aligned with the industry that pandemics are not insurable, that a pandemic event is an uninsurable event. But we do believe insurers have a role to play. We have a role in society. We have a role as experts in risk management. And we also have a role in dealing with emerging and evolving risks. So we developed this concept, and but when you develop something like this, an idea is just an idea, and we believe it had merit. Well, then when we put it in a model, then we saw that it had significant merit, and that's what we want to talk about today. So I'm now going to turn it over to Pete Caminiti, and then we'll have time for some Q&As after Pete presents our concept. So Pete.
Good morning, everyone. Thanks for the time. I really appreciate it. As Deirdre said, I'd like to spend some time. I'm going to share my screen here, and I'd like to spend some time walking you through content that I believe is available to everyone. All of you should have this available. I saw it on your meeting website, so it should be available. I'm going to just highlight a couple of slides, spend about 10 minutes or so walking you through some of the key concepts because I want to make sure we leave some time for question and answers. So as Deirdre said, I really want to start with, why did we start working on this? What were we really looking to accomplish with some type of a pandemic solution? And it really comes down to providing stability and predictability to businesses during, and for us, for Zurich, where we were really focused is on a very specific part of the problem, which is initial shutdown as a result of pandemic. And as we've seen the disruption that was caused in the spring during the shutdowns, at the time, we were all trying to come up with the best way to respond. And what we would like to do is make sure that we have solutions available in the future that are ready to go. A couple of guiding principles, as Deirdre already mentioned, we are, again, aligned with the rest of our industry that pandemic in and of itself is not insurable, and that the federal government really has to have a key role at the table here to help us with the solution. Where our concepts start to differ a little bit between some of the other proposals, and I'll say right off the bat, there is tremendous alignment between, I would say, all of the proposals that are out there. We've got some really core things I think we all agree on, and we have very similar ways of addressing some of the problems. There are some differences between them, and what we were really trying to accomplish with our concept was just bring additional ideas to the discussion. This is, as Deirdre said, not a proposal. We're not proposing any type of Zurich legislation. This is more ideas we want to bring forward to help try to shape some of the conversation so that it works for all stakeholders, both businesses, insurers, government. So while pandemic is uninsurable, we do think it's manageable. We do think there are ways that you can begin to manage portions of the risk, and we think insurers have a pretty critical role to play in that process. So we think it's really important that insurers are present and part of the solution so that we can bring risk mitigation techniques to the table. A couple of things that are really important about, again, I think for any of these concepts, coverage must be affordable. We must drive sufficient take-up rates. We want to make sure that we don't find ourselves in a position where in the future, because of insufficient take-up rates, we find ourselves back into ad hoc disaster relief. It's really important that we drive take-up rates. It's part of the reason why you'll see in our concepts, we want all insurers participating in the process to ensure that there's widely accessible product and that the federal government is a key partner in this to help ensure affordability. Finally, I mentioned the problem that we're focused on solving is really largely focused on that period of shutdown. And the concept that we use to manage that, while we're focused on a very specific part of the problem, we think the concepts that we've put on the table actually can help solve some of the other problems out there as well. You could think about things like event cancellation, other lines of business potentially have the potential to follow a very similar structure as the concept that we're putting forward. So let me just talk briefly about the concept. And again, a lot of these are very similar to some of the other proposals that are out there. So for our concept, the way that this would work, this would be a standalone product. This would be a standalone federally regulated product managed through the federal government. Pricing, product, rules would be set by the federal government. This is where we draw a lot of our similarities to the federal crop program. Zurich is the second largest writer of the federal crop program. And so we're drawing on a lot of our experience with that program. Again, we want to make sure that there is widely available product in the market. So we would require all carriers to participate and offer this product. It would be a take-all-comers approach. Customers would not be required to purchase it, but carriers would be required to offer it and would be required to bind coverage if a customer desired. That creates a bit of a dilemma for insurers, and I'll get to that in a minute and how that would work. The coverage itself would cover 80% of operating expenses for up to a 3-month duration. Again, the problem we're really trying to solve is that initial period of shutdown and making sure that there is some available coverage, predictable coverage available. The way the claims process would work is, again, part of the problem that businesses face is liquidity. So a traditional indemnity adjustment process for claims wouldn't work. We know on business interruption for property policies, that process can take months and months to adjust claims. We need to ensure funds get to businesses quickly. So we're using a parametric insurance model here, which is trigger-based coverage. So rather than a claimant submitting the necessary documentation, et cetera, to begin a claim process, to begin the investigation, getting accountants and lawyers involved. What this would do is this would be based off of a trigger process, very similar to some of the other proposals. You'd have a federal trigger and then a state level trigger that would immediately begin triggering coverage and getting funds flowing to customers. Again, we think there's a big role for us to play from a risk mitigation standpoint. And by getting all carriers involved, we're going to develop new risk mitigation techniques, and then we're going to have that available for our customers. I already mentioned the way the claims process would work. Pricing would be set by the federal government, and affordability is really important. And again, this is where we look to the federal crop program and see for that program to be successful, there's an element of subsidy required by the federal government to make that program affordable. Where pandemic has the potential to differ from crop is a frequency-based event. Every year, premium is collected and claims are paid. Every year there's claims activity on the crop program. Pandemic is a little bit more akin to something like earthquake. You have many periods where you have quiet, you have periods of no activity from a loss perspective, and then you have very significant severe events. So where the federal government can really help from a pricing standpoint is they can take a very long-term view of pricing. They're able to look out and set rates to make sure that while actuarially sound, they can collect sufficient premium over a 50 or a 100-year period to ensure that funds are available to cover those types of events. That's something that private insurers, we would not be able to take that long of a time horizon. So when I think about subsidy from the federal government for this program, it's more based on a pricing philosophy, more so than taxpayer funding. Of course, the taxpayer would have to be there to backstop the program in the event that events happen with a higher degree of frequency. The piece that I want to get to that really differentiates some of our concepts here is, as I mentioned, having carriers required to participate puts insurers in a difficult position because this is risk that we do not see as insurable, yet our concept would require us to offer coverage and require us to bind coverage. So the relief valve for the insurance industry, what we're proposing, again, drawing from the federal crop program, is the ability to then cede that risk back to the federal government at the carrier's decision. So what we've proposed is 3 separate reinsurance pools, again, working similar to the federal crop program, where the carrier decides based on their risk appetite, their financial strength, the lines of business, the products that they offer, the states that they operate in, the types of customers they serve. That carrier then decides how much risk do they want to retain and how much risk do they want to cede back to the federal government. And one of our pools does have a 100% ceded option. And we do that recognizing that not all carriers are created equal. And there'll be carriers based on, again, their financial condition, type of business they write, the geography that they operate in. This may be a risk that they just do not see a way for them to participate in. So their participation is really through being part of the program, servicing their customers, making the product available to their customers, offering their customers risk mitigation, but we're not going to force, our concept would not force that carrier to take risk. Now, if carriers do have appetite for risk, we have a 95% ceded pool, so the carrier would retain 5% of the risk, and a 90% ceded pool, the carrier would retain 10% of the risk. And again, carriers would have the option to participate across all of these pools with no minimums, no maximums on what they could put into any one of the pools. So again, as an insurance company, we can sit here and say, there are certain types of risk, bars and restaurants as an example, may be just too high risk for us, regardless of the size of the carrier. I'm going to place all of that business in the 100% pool. But there may be other types of industries, other types of businesses where we could see a path to sharing some of that risk with the federal government, and we would be able to place that into either the 95% ceded or the 90% ceded pool. So again, what this really allows us to do is to get all carriers participating in the program, all carriers servicing their customers, but giving the carrier the option on how much risk they retain so that there's certainty. So we bring certainty to the customer with how much coverage is available to them, but then we also bring certainty to the insurance industry with how much risk that we're retaining. So again, just very quickly, the idea here would be you would have policyholders coming to carriers, and then carriers would be deciding which policies they're ceding into which reinsurance pools, letting carriers manage their risk. And you'll see in your content, if you want to look at it later, this is some of the underwriting consideration that a carrier may go through their underwriting process to decide how they may choose to place business. Again, it would be up to each individual carrier. Deirdre mentioned modeling. So as part of our work, we partnered with another organization that helped us develop a model. We used Bureau of Labor Statistics data, which gave us really granular information about businesses across the United States by industry, number of employees, et cetera. We got a sense of their expense structure, and we built a simulation model that allowed us to make assumptions around, number one, coverage available. Number two, the take-up rates for that available coverage. So how do we think people will actually, what do we think the buying behaviors would be? And then finally, what do we think the carrier behaviors would be about how much risk they would retain? And based on the assumptions that we ran, we used a $1.1 trillion monthly event, which is pretty similar to what a lot of the experts say COVID equated to. Because coverage is for 3 months, we wanted to see what a policy limit scenario would look like. So we simulated a 3-month event. So that's a $3.3 trillion economic event. So massive numbers here. And we ran that through our simulation. And based on our simulation, what we saw was because of, number one, we're only providing 80% of expenses covered, not 100%. So there's a 20% cutoff of the 3.3 trillion. Plus our assumptions around take-up rate, we would think that this could potentially be a $1.6 trillion insured event under this concept. From there, what we were able to see is then the types of employers who would be receiving that. So roughly 2/3 of that 1.6 trillion would be flowing to businesses with less than 500 employees. We would see that based on our assumptions, the federal government would be retaining 99% of the loss. So the insurance industry would be participating based on our assumptions, 15 billion of that $1.6 trillion. So again, a number that is not necessarily significant for the problem, but it's certainly significant for our industry. But again, the flexibility in carriers to make their own decisions based again on some of our assumptions, we think the vast majority of that 15 billion industry burden would be borne by the largest carriers who would be most likely to be willing to take some of the risk. The last point I just want to make on this is what our modeling allows us to do is then simulate potential outbreaks based on certain states. And we could actually, model how this might move. And one of the things that our concept does not have is a cap to the federal backstop. And we think that's actually really important because depending on how a pandemic could spread in the future, we could see, and our modeling actually allows us to simulate how those federal caps could be eroded based on the way that the pandemic may move across states. And so what we're able to quickly see here is the top 5 states based on our modeling for the amount of insurance that would be purchased. Those top 5 states would account for 42% of the total loss, or $661 billion of the $1.6 trillion of loss. And so that you could see if you're not one of those top 5 states, you run the risk of potentially kind of piercing that federal backstop cap, which is why we think it's really important that a program does not contain a cap. So let me pause there so that we can make sure that we leave time for any questions.
Thank you. I'll get back in. Listen, I appreciate it, and we'll open it up for questions. And Will, you can help me as people want to either voice in and ask questions, or let's first ask if any legislators have a question. I just have one question, and I really like the idea of the 3 different pools. One of the problems we're having is, the federal's aid to different industries is different. And let me give you an example. The hotel, and it's not the federal's fault, but the hotels could not qualify for PPP for the most part in Ohio because they could not, by the contractual arrangements of the debt, that special program the feds have, that they can't take on additional debt. And PPP started out as additional debt, even though it becomes forgiven. So all the hotels, no one could qualify. Very few in Ohio could qualify. So how do you look at, I know how you can get them into different pools, but how can you look at the federal's reaction? Don't you have to have a consistent reaction from the feds?
So the way our concept would be designed is you would have coverage available to all businesses. So it would be a business's individual choice whether or not they wanted to purchase it. But that 80% of operating expenses for up to 3 months, that's the coverage that's available to the customer. The pooling arrangement is more a mechanism between the insurance company and the federal government to then manage that risk. But as far as the customer is concerned, all customers in our concept are created equal. One of the places where we do differentiate is by size. So as you start to get into larger entities, we think it would be prudent for their premium to potentially be a little bit higher, the amount of coverage available to them to be capped so that they don't take a disproportionate share of the relief. But it would be available to all customers.
Yeah, you see in Ohio, there's a big movement to try to get businesses to stay open. As much, we want to protect business, but we also want to stay open. And so one of the things we passed in Ohio was liability protection to the businesses to, get a reinforcement. I don't know how, has that been universal, or the Fed stepped in where they have liability protection? Because, a lot depends on whether the business will continue to operate or not continue to operate. And they want protection in case, they operate and then their employees come down with the virus.
So I know liability protection is an important part of the current legislation that's being
Right.
considered by Congress. It's not something that we've worked on as part of our concept. Our concept is really helping to make sure that businesses have liquidity.
And I understand that, but I'm just saying, when you're doing your premium calculation, I would look at, you want to keep the business operating, et cetera, and not give them an access to not operate. I'm going to open up to other legislators. Any questions from other legislators? George, you always have a question.
Senator Hackett, I do have a question.
Yes.
This is Matt Lehman in person. And this question goes to Peter, and that is, looking at your model when you talk about pricing, I guess I've had two concerns, and I'm in favor of bringing the carriers into some form of participation, more like the TRIA is. When you do that, though, the issue kind of becomes, what do the smaller carriers from a portion of the other? We've got some small mutual companies that we utilize, and can they take on the risk that maybe a Zurich can take on? That's one thing. And then the pricing of this to the consumer, when you talked about the 5 states, like terrorism, if I'm in an area that's more susceptible to terrorism, my premiums are higher. I think you got the 3 tiers of pricing when we price this out on a product. Is it kind of, when you ran your simulators, did you simulate premium as well to find out what it would be for a small restaurant in a small town? Because I guess the whole thing with pandemic is, you assume it's going to be much greater in more metropolitan areas, but that might not be the case. So how did your modeling work through pricing?
Sure. Let me first take the carrier piece, and then I'll get to the pricing piece. So actually, one of the key pieces of our concept, and the way that we landed on our concept, was so that we could think about the decisions that a small mutual may be making, only operating in maybe 1, 2, or 3 states versus a national or global carrier. Where we think our concept works for those carriers is in a couple of ways. Number one, yes, we're asking them to participate in the program, but we're not forcing them to retain risk. And we're not creating market distortion by then saying, well, if that carrier chooses not to participate, some other carrier will, which will potentially disrupt that other carrier's ability to retain their customers, right? So we want to make sure that any solution doesn't become market disrupting. And so that's part of the reason why we think it's really important actually to give all carriers an option to participate, a way to participate, a means to participate, but then give them also the means to decide on how much risk they want to retain. So that mutual can continue to service their customers, make this available to their customers, but decide they don't want any of the risk. And that would be perfectly fine under our concept. As far as the pricing goes, because pandemic actually does behave differently than other perils, there's not a coastline, there's not a fault line, there's not an urban center that necessarily kind of distorts the risk. We thought about pricing more so by customer size, and then we looked at it based on duration or the frequency of the event. So the point about the federal government being able to help subsidize rates, when you look at a 50-year return period, that would equate to a 2% charge for the limits provided. So if you're a restaurant and say you have I'll do simple math here, you're a decent sized restaurant, you've got a $1.2 million annual operating expenses. 3 months would be 300,000. 2% of 300,000 would be the premium charge for this coverage protection. So we were thinking kind of along that 50-year return period, probably 2% for businesses less than 500 employees, and then it would go up probably 3%, something like that, for larger companies.
Appreciate that. Thank you.
Thanks, Matt. Next one that has a question is George Kaiser. Go ahead, George.
Thank you, Mr. Chairman. Peter, you know, I looked at the triggers that were listed, and I hate to say it, but it started to look a little bit like cancer insurance, that those triggers can't be met. I mean, they're so extensive, and for when we have administrations telling businesses, bars or restaurants, that they can operate at 25% capacity, and especially if they can't serve alcohol, there's no way they can make it. The pandemic is going to put them out of business, and yet they're not going to qualify under your triggers. So your insurance product, boy, to meet those triggers is pretty difficult, and it doesn't address really the reality of the impact of a pandemic on small business.
I appreciate those comments, and I think this is part of the reason why we think public-private partnership is so important here. A private solution, a private product solution without working in conjunction with the public sector, I agree, wouldn't work. And for some of the reasons that you just said, that's actually one of the things that we considered and had a lot of discussion internally about was the triggers. Based on how, whatever the end, again, what we're trying to do is introduce concepts here to further the dialogue. Whatever the trigger mechanisms ultimately work out to be, and whatever the final program could potentially be, it's going to be so important that the product work hand in hand with the government response. And so and one of the things, exactly as you mentioned, that we discussed, and I think is still a problem to be solved, is how do you deal with partial closures? How do you deal with essential entities that have not been ordered closed but are being affected? And I think there's certainly room for us to continue to work on the trigger mechanism. The triggers will be so important by the people who are actually signing the orders. And so they have to have, this has to work hand in hand with the public response in addition to the product. So I agree. I think there's work to continue to do on the trigger mechanism, as well as what the public response would be, to make sure that it's having the intended purpose. And again, the intended purpose here is solving a liquidity problem during a period of shutdown or disruption as a result of, again, our focus has been that initial response to a pandemic.
Mr. Chairman, if I could follow up, Mr. Chairman, with one more question.
Sure, go ahead.
But Peter, I recognize that ideally we have a public-private. You can see, just as we can see, that federally, they're really struggling with this next phase. And the minute we put the private sector into the mix, the public sector is going to back off and say, hey, you know what? If you didn't buy the right insurance, why should we be bailing you out for that partial closure? Their triggers are going to change, their participation. So I don't think it's nearly as simple as a public-private partnership.
Yeah, I was just. Okay.
Go ahead.
Yeah, I was just going to add that, as we get into the pandemic, as it
need to have more
forward, we're learning more and more. We're getting more and more data. We're seeing the different things that are taking place, and all that will go into, as we said, ours is a concept, not a hard proposal. And so as we gather the more data and live through this pandemic, we'll be able to look at those types of items and change and look at the triggers and look at the other areas and make changes to them to keep up with what took place.
Yeah, I see that the Congresswoman has joined us. Can we hold off on any questions until she gets done? Because I know she's on a fairly tight schedule. So I want to introduce Congresswoman Carol Maloney, who's the chair of the U.S. House Committee on Oversight and Reform. And she's the lead sponsor of the Pandemic Risk Insurance, as we all know as PRIA. Congresswoman Maloney, are you ready?
Can you hear me now?
I can hear you now.
Okay, thank you so much, Chair Senator Bob Hackett, for inviting me to discuss. Adrian, please. Okay. I wanted to, first of all, thank you for inviting me to discuss my bill, HR 7011, the Pandemic Risk Insurance Bill. And it's very important to me, very personal to me. because of 9/11. And I remember vividly that after the terrorist attacks on 9/11, the economy of New York completely shut down. We couldn't build anything. We couldn't even, we couldn't get insurance for a hot dog stand. No one would give us insurance except for Lloyd's of London, and it was incredibly expensive. And we couldn't build because insurance companies would not insure any property against a terrorist attack at a terrorist attack site such as New York. But Congress recognized that if companies couldn't get terrorism insurance, then there would be no more construction, millions of jobs would be lost. So we came together in a bipartisan way to solve this problem and passed TRIA, the Terrorism Risk Insurance Act. TRIA successfully unlocked the terrorism insurance market, got the economy moving again, and put men and women back to work. And while we know NCOIL is committed to preserving state authority over the regulation of insurance, just like it recognized federal action was needed to address terrorism risk insurance with TRIA, it's safe to say, I think we all recognize federal action is needed again to address the pandemic risk insurance challenge. And that's what we're trying to do with PRIA, or the Pandemic Risk Insurance Act 2. Since the pandemic was declared, tens of thousands of small businesses have closed their doors permanently across our country. Entire industries like travel, tourism, film, conventions, televisions, hospitality have been upended. Small business owners who purchased business interruption insurance policies expected pandemic-related losses to be covered, only to find their claims unexpectedly denied by their insurers. And then to make matters worse, insurers have recently rewritten policies to guarantee that future pandemic-related losses will never be covered. So for the remainder of this pandemic and future ones, small businesses and entire industries have no way to protect themselves from pandemic-related losses. We simply can't continue to expose our economy and small businesses to this level of risk and expect them to recover. And we can't expect our economy to be resilient in the face of pandemics if we're left gambling that Congress can cobble together an emergency bailout next time. Just look at Congress now. We still haven't passed another PPP bill for small businesses and other things that people need. We know the federal government will step in during the next crisis. So why not be proactive and develop a long-term solution? The Pandemic Risk Insurance Act, or PRIA, is that long-term solution. PRIA would create a forward-looking public-private risk-sharing federal program supported by a robust federal backstop that would require participating insurers to offer business interruption insurance policies, including event cancellation that cover pandemics. To be clear, PRIA is not retroactive. It is forward-looking solution, and PRIA would create a totally voluntary program. Insurers can opt into the program, and policy holders aren't required to purchase pandemic risk insurance. But if businesses want to buy pandemic insurance, then under my bill, they could. The program would be triggered once 3 conditions are met. First, the pandemic has to be declared and certified by HHS. Then the total insured losses for the pandemic have to exceed 250 million, which is a very small amount. And finally, each participating insurer has to pay a deductible equal to 5% of the premiums they earned in the previous year. Once these 3 conditions are met, the federal government would start sharing losses with the private sector. Specifically, the private sector would bear 5% of the losses, and the federal government would bear the remaining 95. The program is currently capped at $750 billion, and the Treasury Secretary will determine the risk-sharing split beyond the cap. Importantly, for state, the bill also says that for participating insurers, any exclusions that are in effect on the date of an enactment that specifically exclude losses covered under PREA are void, and any state approval of those exclusions is preempted unless the exclusion can meet certain criteria, such as written approval from the policyholder. We worked with the states on this provision, which I believe strikes the right balance. Since I've introduced the bill, I formed a PREA coalition consisting of more than 2,000 endorsing organizations, a PREA working group, which NCOIL is a member of. And just before the Thanksgiving holiday, the Financial Services Committee held a hearing on my bill. So in light of the progress we've made in the last few months, I feel confident that we have a very real window of opportunity between now and the end of the first 100 days of the Biden administration to get the bill passed. And I look forward to future discussions, and I have time for one question. We are closing down here. We are on the floor. There are votes, and a lot of things are breaking with the legislation that I've sponsored that is being considered as we speak in negotiating rooms. And so I need to get back there. But I'll take one question, please. And my staff is on the phone. Jake Friedman's on the phone, and he can also answer any questions if you need any other clarifications on the bill. But understand this is, you know, you're all legislators. It's the closing day practically, and a lot of bills are moving, and we need to negotiate provisions between the House and the Senate. So I'll take one question, Senator Bob Hackett, if you'd like, or I'll just let you go back to your meeting. What do you think?
Listen, I have a question, but I'll let our president, Matt Lehman. Matt, if you want to answer ask the one question, go ahead. If you don't, I have one. Go ahead.
I'll defer to you, Bob. Go ahead.
Okay, yeah. Madam Congresswoman, what's the biggest hurdle in getting the support for PREA and moving it forward? What's your biggest problems of getting the bill passed so far?
Well, it's quite frankly, I've never written a bill that got as much support as this bill. Even before I wrote it, I had people calling and saying they wanted to sponsor it. So there is I would say, massive grassroots, industry related, from both the real estate and business, and particularly small business, in support of it. Every piece of legislation is extremely difficult. I'm just passing today a bill I worked on 15 years just to place a women's museum on the mall. And there's still a lot of things that they want to negotiate on it. So every bill is hard. This bill is particularly hard because it is so massive. Unlike TRIA, that was just a few places in the country that are terrorist targets, this is for every single neighborhood in the country. Because when the pandemic hits, it hits every state, it hits every neighborhood. And we're concerned that given the way the world is today, that we'll be struck with another pandemic. So why not get ready for it? We did do a lot of things to help small businesses, but it was hard to really negotiate them piecemeal. And right now we have a short-term strategy of getting a relief package in the next COVID bill for small businesses, but we need a long-range plan. To be honest, it was very difficult at the beginning because we were competing with 100 other legislative proposals for COVID relief, and many that struck the same issue that I was working on. It took some time for the pandemic insurance cases to work their way through the courts, but now we've had a Financial Services Committee hearing on the bill just recently, which was a critical step to build the support within the body. And the hearing was great. It demonstrated that there is an overwhelming need for a public-private partnership like this. And we had expert witnesses testifying that it is absolutely doable. Many people were saying there was no way you could do that, but we had major industry stakeholders testifying that it was doable and they wanted to do it and they wanted to work with us in making it happen. Having the hearing, I believe, was a critical step in the legislative process. It sets the bill up for a markup later down the line. I also point out that when I first introduced the bill, some argued that pandemic risk was fundamentally uninsurable under any circumstances, and that a program with a public-private risk sharing wasn't workable. But since then, there is a broad consensus that is formed from many policyholders, stakeholders, some insurers, that pandemic risk is insurable with a public-private risk sharing program supported by an appropriate federal backstop. And that consensus was on display at the hearing. Insurers like Chubb, who testified at the hearing, and Zurich Reinsurance have released pandemic risk insurance proposals of their own, as have other policyholder groups. And even the insurers who didn't originally support federal legislation on this issue have come around, and they've come out with their own proposal, recognizing that pandemic risk insurance is a viable product. I also believe making the bill bipartisan is an important step. You cannot pass it or get it signed into law. The best legislation is always
Am I the only one having issues, Congresswoman? You cut off on my
No, you're
iPad.
not, Senator. It's
Okay.
on her end, I believe.
Okay.
Yeah, froze, system froze.
Yep. Sorry. Yeah. She only wanted to answer the one question, so we'll wait just a second, see if she comes back on.
Well, I guess we can say, if she's listening, thank you very much for that presentation and for the work you're doing.
Yeah, we really appreciate it. I think, and they've taken out any type of retroactive, that's an issue. The only other question I had was on this next package, is she trying to get it into the next CARES COVID-19 stimulus package? I don't know if she's trying or not. Anybody on the phone, can they answer that? Is she trying? Do you know? So I think we've lost her. And so I'm going to go ahead and go to the next subject, if it's all right with everybody.
Chairman
next
Hackett,
is-
Chairman
Yes,
Hackett,
go ahead,
can
Matt.
I go back to a question? I know we wanted to get to the Congresswoman when she was available, but
Yeah.
I guess I want to go back to the question because I just doing some math here. Back to the presentation by Zurich. If I wrote this down correctly, they said, yeah, you take your exposure, annual exposure, take the months you want to purchase, and it's 2%. If I just did a local restaurant that does say $600,000 a year, that's $75,000 for 3 months. If I take that times 2%, that's $1,500. That becomes almost, it looks like flood insurance, but it's almost unaffordable for that one peril.
I agree.
So when you've done I guess the question's open to the industry in a way. When you start to do your analytics on this, is how many people are going to buy a premium that they're spending $1,500 on a premium that covers one peril, and then don't we set this up to be, well, now I've got a choice as to whether or not I want to buy this, and I decline because I can't afford the $1,500. Now I'm in a position where I'm going to get no benefit because nobody's going to help me if I have a loss because I chose to decline the coverage. So how do we make it, unless I'm doing the math wrong, how do you make it affordable? Because otherwise you're going to run the same problem you have with flood insurance, and that is nobody buys it and then the system goes broke.
Well, and I appreciate, and you add on the fact that what George said too, when you read it, what the triggers are. And so I agree with you 100%. So I think Zurich's got a little more work to do to bring that idea back to us.
Yeah, and I agree. This isn't the last time we're going to talk about this. So just to put that out there is something maybe a little more data would be nice.
Okay.
Sure. And if I could just comment on that. No, I think that's what you're highlighting is the challenge we're facing here, and that's why, as I mentioned earlier, requiring federal participation is so important here. Because as you can see, even taking something like a 50-year return period view, which again for the private sector, for the private insurance sector, would be very challenging for us to justify taking such a long return period, still creates a premium that could be very challenging for businesses. So I think this is where, again, our concept starts with what might be a place you could start. But as you said, I think this is where further support from the federal government would definitely be necessary to talk about premium subsidy.
Yeah, but it's so hard to get the federals to agree on anything because you have such difference in the politics. I mean, look at the pack of getting this third help package. You know, you can see the problems we've had. And Matt will tell you, in Ohio and Indiana, we had the same problems. There are a lot of people, business in Ohio, think the feds overreacted in some ways in the amount of monies they gave to employees. They were having trouble getting employees come back to work because they were making more money sitting at home than they would be working. So it's hard. Thank you. Let's move on. The next topic that I have on the discussion is discussion of Canada Life's and health insurance marketplace response to COVID-19. I know they weren't at the last one and they'd like to respond. We have Stephen Frank, who's president and CEO of Canada Life and Health Insurance Association. Mr. Frank, are you on?
I am, Senator Hackett. Thank you for the invitation today. I trust you can hear me okay?
Yes.
Very good. So I will also share my screen and let me know when that pops up for you all. So hopefully that's...
We've got it.
Very good. Okay, let me just get it into a presentation mode here. Okay, well, we're gonna spend the next sort of 15, 20 minutes on a different type of insurance. We speak for the life and health insurance industry in Canada, and there have been some interesting implications of COVID on our industry here as well that would be in some ways very similar to what's happened in the US, but there may be some nuances here. So what I thought I would do today is almost set a bit of the context of who we are in Canada and the product lines that we operate in. So a quick few minutes just on what life and health insurance is and is not in the Canadian context. And then walk through sort of our COVID journey. And when I was reflecting back on the last 8 months, I sort of think of it in 3 buckets. There was the first almost week where there was just this frenetic activity and there's a whole bunch of things changing quickly. And so I view that as almost like a discrete period of time. And then there was the next sort of 3 or 4 months when a whole bunch of new programs and initiatives were rolled into the market that helped stabilize things. And then we sort of evolved into where we are currently. So I thought I would sort of walk us through that journey and some of the implications that we've seen in Canada. And then crystal ball a little bit out what may be coming. And I think there's, clearly more questions there than answers at this point. But there are a lot of things we're starting to think about as the light is starting to come to the end of the tunnel with the vaccines coming online. So just a quick snapshot of the Canadian life and health industry. Broadly, carriers in Canada do not do both property and casualty and life and health business. There are a few that span both, but by and large, companies are specializing either in life and health or in the P&C. And in the Canadian context, that would essentially mean the 3 lines of business you see there: life coverage, health insurance, which I'll spend a little bit of time on in a moment. And then we have a big role to play in helping Canadians save for retirement through employer-sponsored programs. There are about 64 individual companies that operate in this space. When you add up all their subsidiaries and affiliates, you get roughly 160 or so that compete in the market. And just to give you a bit of context for some of these numbers around number of lives covered, population in Canada is about 36 million. And so, probably 70 to 75% of individuals are touched by the industry in one way or another. So on the life side, I'll let you sort of look at the screen while I comment on this, but a couple of points to highlight. By and large, life coverage is sold through the individual market in Canada. So not through, there is some bundled life coverage in a typical employer benefit plan, but the majority of it's sold through an individual channel. Companies in Canada over the last 30 or 40 years have by and large outsourced their distribution. So this is done primarily through advisor and broker, independent advisor and broker channels. And we'll talk a little bit about that because I think one of the big impacts of COVID has been our relationship with the advisors and how we've been supporting them to continue the distribution out, out to Canadians. And you can see an average sort of plan in Canada is about $420,000 of coverage. On the health side, it's sort of the exact opposite scenario. The vast majority of it is sold through an employer program. So these would be health benefits offered to the employee benefit package, very similar to what you would have in the US. I think generally people are a little surprised at the role we play in Canada. There's a view that we've got Medicare in Canada, which is government covered, and that is true for hospital costs, physician costs, and a portion of your prescription drugs. But beyond that, it's really on to individuals to self-insure either through an employer or other types of coverage. And so about 30% of total spend in Canada is actually paid privately. And the vast majority of that would be through sort of a group plan. So in addition to, so what we would cover would be sort of prescription medications, dental coverage, paramedical, so your physiotherapist, chiropractic type scenarios. And travel insurance is often included in there. We'll talk a little bit about that in a moment because that was right out of the gate and continues to be one of the big challenges within the industry in sort of a global lockdown type scenario. And then finally, retirement solutions. Again, the majority of this is offered through an employer relationship. You would have sort of group savings programs. It could be a defined contribution or defined benefit plan. We also, distribute retirement savings, products, annuities, segregated funds, things like that directly, but again, through a broker and advisor channel, sort of independent of the insurer. Probably about 70 to 75% of the group pension plans in Canada are administered by the private sector. The bulk would be done through, union arrangements or civil service type arrangements. The teachers may have their own program or something like that. So very large players or the retirement program. And each of these had some pretty major impacts through the crisis. So just to quickly on our COVID journey, as I said, sort of break it into three pieces. And I'm going to focus on those areas where we had a really good collaboration and work closely with legislators and regulators across Canada. The first thing that hit literally within the first day is how we were going to get our workforce to be able to work remotely, how we're going to make sure that we continue to be able to provide claims and other services to Canadians. Like a lot of industries, it was a surprisingly smooth transition. No one would have expected that, in an unplanned event between one day and the next, you would move 95% of your employees to home and there wouldn't be a large disruption to our services. But in the end, that's effectively what happened. So it was a surprisingly smooth transition. We did have to do a lot of work with provincial and federal governments in Canada, and I know the similar discussions happened in the US to designate certain industries as essential. And so the insurance industry within quick order was deemed an essential industry, and that allowed us to keep a skeleton staff coming into work and maintaining our IT systems and claim systems and stuff. Roughly 90 to 95% of employees in Canada are working from home within our industry at the moment. Only about 5% or so are going into the office with any regularity. Within the first week, there were many hundreds of thousands of Canadians traveling. I was one of them. I was on a beach in St. Martin, just about to start my March break, and that was immediately disrupted. And so getting everybody home was an enormous undertaking. And for the industry, everybody was trying to activate their travel claims. And so, the working through what were the eligible amounts, working through how to get people home safely, the call center overload was a real challenge for the first many weeks. That was just a huge lift to sort of bring everyone back safely in an orderly fashion. And then ironically, we had sort of the flip issue that revealed itself fairly quickly. And basically it were those that were abroad, and many of them would be down in Florida, and I'm sure in the Tampa area, there were a number of them, what we call snowbirds who, quite frankly, had the view that they'd rather self-isolate somewhere warm than come back into the snow. And so there was quite a effort that we needed to undertake to explain to people that their coverage, had some risk associated with it in a pandemic scenario, and to get them to take seriously the need to come home. And so there was a couple week or month period where we were doing a lot of collaborative messaging to travelers about the need to come home. And I'll circle back to that towards the end, because we're starting to see people going abroad again to try and escape the cold weather, and that's creating a bit of a challenge. On the healthcare side, many of the benefits, and this would be the same in the States, if you want to qualify for a disability benefit, you're going to need a physician visit. You're going to need some kind of attestation from a physician around the need for that. So getting doctor's notes. If you're on a high cost medication, you're going to need some kind of pre-authorization signed off by a physician or at the pharmacy potentially. All those processes that we had in place ground to a halt. I mean, with no physicians working, with pharmacy closed or on reduced hours, we needed to very quickly provide undertakings to allow those benefits to continue. So as an industry, collectively, we made decisions around waiving wait periods, foregoing doctor's notes. We tried not to make it a competitive issue. We tried to make it doing the right thing for our customers. And so there's a lot of forbearance that's been introduced into the market. And then over time, we're having to rethink what can stay and what may need to go. And then there's a lot of commercial traffic that flows between Canada and the US. So these would be truck drivers, bringing food or medication across the border, other types of essential products. And they needed to have health coverage in place for them to agree to do that. And generally in a pandemic scenario, we wouldn't, offer that kind of coverage. You would expect people to stay home. And so again, we had to step up and provide some unique solutions there to allow that cross-border traffic to continue. So, when you sort of think about that, all these issues were brought to ground probably within the first 2 or 3 weeks. It was a very frantic period. Then we settled into a bit more of a new normal, and I call this freezing everything in place, because that's sort of the way we were describing it. We really wanted to work with government on the wage supports and other types of employment supports that were being rolled out, to work collaboratively to keep employers solvent, to keep the employee-employer link to the highest extent possible, to make sure that those benefit plans were maintained. We were really looking to almost freeze the system with the view that this was a supply shock, not a demand shock, and that once the pandemic passed, it would be the best way to sort of accelerate the recovery. And also, we didn't want people to lose access to their benefits, obviously. And certainly at the time, I don't think we anticipated we'd be in this for well over a year, and that's sort of what it's looking like. It's going to be the reality. But at the time, there was a view we could try and work our way out of this fairly quickly. So a lot of very collaborative work with the federal government to introduce, historic wage supports, as is the case in the state. Similar scenario here. Very, very rich salary supports and wage supports were rolled out to governments, but I think we were very supportive of that. And at the same time, companies were rolling out direct support in the hundreds of millions of dollars to employers in the form of credit refunds, premium deferrals for employers that were struggling. A lot of that was in recognition of the fact that many of the types of services that employees would generally avail themselves of weren't happening. So, no one was going to the dentist for the first several months. And so, a lot of support from government and the industry back in. And the good news is, through the crisis to date, there's only been a 1% decline in lives covered by the private industry between March and today. So it's been a very resilient system and has come through it quite well, a lot, in many reasons because of these supports that were rolled out. An incredible re-engagement with regulators, meeting with both the prudential and market conduct regulators multiple times a week, ensuring the solvency of the industry, ensuring the market conduct rules and distribution was still in play and that consumers were still being treated fairly. And so a huge engagement there, and I think very productive. And it sort of feeds into the last bullet here. Our distributors, and I think this is probably the same in the States, had a lot of paper processes, a lot of requirements in legislation for things like wet signatures, the need to do your credentialing exams in person, things that we had always had in mind of wanting to address, but never quite got to it. Well, the silver lining in COVID is that we were able to break through some of those issues. So moving to a virtual sales environment, empowering the brokers and advisors to do that, creating an experience for clients to onboard them that's more virtual and smooth. There was a huge lift there, trying to get that right. We're still working on that. And then from the carrier's perspective, some big changes to how we underwrite. So the no fluids limits were changed, great partnership with the reinsurers, the use of data and big data to rethink what we collect in applications. All that was underway right at the beginning and continues to this day. I'll just highlight here quickly, mental health is a growing problem in the pandemic environment. I would expect very similar in the US. The isolation issues and stress are real. We're seeing that in our claims data. So there's been a huge focus on new solutions and services around mental health, and virtual healthcare is really working its way into the norm now, and again has been accelerated by 10, 15 years over what we would have expected as a result of the pandemic. So there's a huge amount of activity there within the industry and within employer benefit plans to try and leverage that. So where are we at today? The industry has come through extremely well. Our capital levels are actually have risen in some cases. Sales levels have rebounded. One of the good things of working in the insurance industry is in the life and health in particular, is we've come through this extremely well and we're well positioned for the future. And so, but we continue to watch that pretty closely. And from a regulatory and legislative perspective, the priorities that we sort of had in, sort of January, February were put on pause, but we're almost back to where we were in the February timeline with respect to working with our market conduct regulators, our prudential regulators. Legislation is starting to roll through again. And so we're slowly getting back to the normal cadence of work, which I think is really, we're all very pleased to be there. One of the big lifts in Canada is that we are, as a industry, rolling out the new IFRS 17 accounting rules, and that's an enormous sort of change for the industry and has a lot of capital impact. So there's quite a bit of work happening there to put that new regime in place and working with our regulators. New products. So snowbirds are starting to travel again. They want to get back to Florida. They want to get to Arizona. They want to go to Mexico. So there's some really interesting travel coverage that's being provided that does include COVID protection now. And people are starting to explore and be innovative there. Simplified underwriting continues. Lots of use of big data and virtual solutions to try and onboard clients. And the shift to the virtual environment is just sort of the big theme of the day. Updating our distributors' capabilities, having them the ability to have their client discussions virtually and sort of do straight through processing of claims changes and inquiries and stuff is a huge lift right now. And there's lots of really interesting stuff happening in there. So just some quick observations. What do we see out maybe out over the next 12 to 18 months? Huge uncertainty. We're in a second wave of COVID here in Canada. I'm sitting in Toronto and theoretically not supposed to leave my house for another 2 weeks. So we're all locked down again, and there's some pretty punishing lockdowns in place. We don't know what the winter brings. The numbers are up again. So there's just uncertainty is the path there. Vaccines have started to roll out, but how long till those are in a meaningful way getting distributed? A big question, it's going to, listening to the earlier discussion, I think it's going to be true in probably every country in the world, is that the interrelatedness of government and business over the last 6 months is just extraordinary. And we didn't start down this path with any kind of principle or work our way up to it with some kind of master vision here. It was a very ad hoc type of endeavor, but nonetheless, how that works its way through over the years and how is that unwound and what's the appropriate role of government and insurance on some of these issues. I mean, there's just a huge amount of work that's going to need to be done over the next probably 5 to 10 years as we slowly work our way out of this. And that has big impacts for the insurance industry. And then of course, how does business recover? So for companies, what's the new normal for employees? That's going to be true everywhere in the world. Like, are we bringing everyone back to office? What's the new normal going to look like? How do we transition there? lots of questions around that. We've been talking about ultra low rates and asking ourselves how long those can continue since 2008. And so we're 12 years in. I think the view is there's no end in sight to the ultra low rates, and that has big impacts on life and health insurers. We've learned to manage within it, but there's always that hope that someday we'll start to see some higher rates. And so there's product changes, there's all kinds of implications of those low for long rates that we're still working through. Advisors and brokers are going to have to learn to do their business in a different way, as are we. That journey continues. We're not yet seeing morbidity and mortality impacts from COVID, but we anticipate those will start to materialize with time. And so how does that impact products and pricing and positioning in the market? Those are all big uncertainties. And then the last bullet, I'll just say that for this audience, the collaboration between government and industry and regulators and industry is absolutely critical. We've got to move to some kind of new normal, and that transition has to happen in as orderly a way as we can. And so we continue to look to really good relationships there with our governments, and so far it's been very positive, but we need to sustain that. And it's a medium-term effort. It's termed in years, not months, as to how much longer till we work our way out of this. So that's a whirlwind tour. I hope that was somewhat interesting, but I'm more than happy to take any questions or observations you may have, and I'll just stop my sharing now. So over to you, Senator Hackett.
Yeah, Mr. Frank, thank you. Thank you for your points. I just have one question. Thanks for asking left field questions. One of the things our health insurers and all of us are saying in Ohio is we are just completely pleasantly surprised with how much telehealth is being used. And I mean, it's just no one forecasts to the level. And even, if you look at our Medicaid issue, that so many people use the emergency room as their primary care physician now have moved to telehealth, and it's really helped in a lot of areas. And we as legislators are sizing the opportunity to develop, legislation that makes it works in the future. And we're doing it administratively versus legislatively, even though there are bills pending. And we don't have as much of a broadband issue as maybe you do in Canada. But one of the things we've found is that the technology needed isn't as great as it once was forecasted by the providers. I've had 3 telehealth appointments, and everything's iPhone to iPhone. I know you do have to have an iPhone, so broadband does coming in. But what are you hearing from your health insurers about telehealth?
Yeah, they've been amazed at the pickup on it. And it's the new wave. And once I've had a similar experience, once you've done it once and you've not had to take the day off work, go to the doctor's office, sit, and they're always late, so you're burning half a day to go. You're just never going to do that again if you can have a set time and you talk to someone on the screen. So I think the patients are going to drive this. We see it clearly. Big interest on employers to start to offer some of those bundled solutions, and in particular on the mental health space, where I'm not sure how it is in Ohio, but the supply of mental health professionals is really concentrated in some of the cities. It's hard for people in rural areas to access those. So we'll see a lot of opportunity here and a lot of investment and excitement around it for sure. How that interplays with our public system, and that's still all to be worked out, but there's no question patients are going to drive us there. And it's one of the silver linings of the crisis for sure.
Yeah, I understand. Any questions? Anybody want to pipe in? Will, you haven't sent me anybody have said that they want to ask a question. And I don't see anybody. I think we're good if anybody doesn't pipe up. Mr. Frank, thank you. Really appreciate your
my
time.
Pleasure. My pleasure.
Yes.
Have a great rest of your session, everyone.
Yeah, you have a great day. Thank you. The last area of business today is the readoption of the market law. This is the Market Conduct Annual Statement Model Act. It was first adopted in 2010, readopted November of 2015. And everybody note that the model's in your legislative binder on page 66. And per NCOIL bylaws, of course, all model laws sunset every 5 years. So we have to go through a readoption. So are there any questions on the model? Tom and Will are also on the line and Matt can answer that I can. Any questions? If none, can I have a motion to readopt the model?
So moved.
So move.
Okay, appreciate it. And then a second?
I'll second it. I think I came in on the.
Okay, I appreciate it, sir. All in favor, say aye.
Aye.
Aye. All opposed? Motion carries. Any other business today to be brought before the committee? If not, we stand adjourned. And Will can't believe it. We're 3 minutes ahead of schedule. How about that, Will? So everybody have a great day. Thanks for joining us. The next topic on the thing as I open the book is a 145 meeting. Chairman Hunter's, Pam Hunter's health insurance and long-term care. And there, I know there's a number of issues we're going to be talking about. So, and I will be on that one too. So see everybody there. Thanks everybody for joining us. Have a good day.
Good afternoon. Welcome back, everyone. I want to make sure that all of our legislators are online and ready to get started. Before I call the meeting to order, I just want to acknowledge the fact that Arkansas just won the PBM regulation case in the United States Supreme Court. I know we've talked about this at NCOIL several times before, so take an opportunity to look at the decision and read the opinion. But this is big news, obviously, for the Health Committee. I'm going to call this meeting to order, and I'm first going to call the roll. I'm going to ask that any legislator on Zoom please identify themselves so that Will can take attendance, please.
Assemblyman Kevin
Representative Jim,
New York.
Representative Jim Gooch from Kentucky.
Delegate Steve Westfall from West Virginia.
Deborah Ferguson, Arkansas.
Peggy Mayfield in Indiana.
George Kaiser, North Dakota.
Sorry, Bob Hackett, Ohio.
Are there any other legislators on Zoom that haven't identified themselves yet?
Yes,
Derek
Wendy,
Lewis, Kentucky.
Wendy Thomas, Pennsylvania.
Representative Lewis acknowledged he was here as well.
Thank you.
Any legislators present in Tampa, please acknowledge your attendance.
Representative Carbaugh from Indiana.
Representative Lehman from Indiana.
Senator
Representative
Gaskell
Fisher.
from Indiana.
Yeah, it's fine. And just start.
Okay, if
Paul
that's
Etke,
it.
Minnesota.
Oh, thank you.
Joe Schmick from Washington.
Thank you. Okay, thanks. I'd like to ask for a motion to waive the quorum.
So move.
Second.
All in favor?
Aye.
Opposed? Abstain? The motion carries. I'd also like to make a motion to adopt the September 26th, 2020 committee meeting minutes.
So moved.
Second. All in favor?
Aye.
Opposed? Abstentions? The motion carries. We're going to change the order of the agenda just a little bit because we want to make sure we take care of old business first. I know in your book, it says we're going to talk about the telehealth model first, but we first are going to consider the NCOIL Vision Care Model Service, Vision Care Services Model Act. And I would like to turn it over to Senator Hackett for a few brief words.
Yeah, thank you, Madam Chairman. I just want to say on that we worked really hard, and I appreciate both sides. We worked really hard on the model, but we're going to actually, I'm going to ask that we table the model. And if you guys remember, is we were able to get this done in Ohio, where Ohio can't get the teledental, the non-covered items on the teledental, and I think the optometrists nationally would like to get, something like what we did years ago, outlawing non-covered items coverage on the, or actually, provisions that the dental insurance companies did. So So since the committee, and I appreciate all the work you've done, Madam Chairwoman, but the committee's not there yet. So I think the best thing we should do is table. I don't know if Robert's on the line, and he might be on the line. Yeah, and I think I think they'll probably go in and talk to individual states as they have in the past and gotten other states interested. And then we may look at this model later on down the road. But I just like to move to table the model right now.
Okay, so you're asking to table or withdraw? We just want to make sure, is this going to be on a future agenda, or would you like to withdraw it and then someone at some other point could, or you at some point could reintroduce?
Yeah, I mean, if you table it, no, we're not going to bring it on the next meeting.
Okay.
So, yeah, so I don't know which to do, table, withdraw, but yeah, we plan on bringing it back, but not at the next meeting. Okay.
Okay. All right.
So whatever you think.
Okay. Well, at this point, we will move forward. Thank you, Senator. I know that we've had many conversations over the past several months with
Appreciate
many
your
folks
work.
relative to this model, and look forward to it sometime, perhaps in the future, having another go at it and getting a little bit more consensus.
Thank you.
Thank you. We're going to move forward next on the agenda to the NCOIL transparency and dental benefit contracting model. And I'd like to thank Representative Kaiser for his initial introduction of this model. And since that time, Representative Ferguson has taken over the lead sponsorship. And I'd just like to ask if Representative Kaiser might have just a few words before we get started. We will be taking a vote on that model today as well.
No, Madam Chair, I'm just observing today.
Okay, thank you so much, Representative. I'd like to turn it over to Representative Ferguson to be able to have a couple words.
Thank you, Madam Chair, and thank everyone for their hard work on this model. For the legislators that in your binders, the act starts on page 106 because I do have a few comments to make about some changes. We have come a long way with the model since it was first introduced by Representative Kaiser back in December of 19. And I don't know about you all, but that feels like that was 10 years ago. The model actually started out with 5 substantive sections, but in a great show of compromise among everyone involved, we narrowed the model last time to 3 substantive sections. They're the network leasing, the prior authorization, and the virtual credit cards. And I'm proud to say that there's been numerous compromises on both sides, and I think it's a really good bill now. These issues are very important to me. Obviously, I'm a dentist, and I'm confident that the language you see before you meets the ultimate goal of transparency, because transparency in dental insurance and dental care is really the ultimate goal, which is why the word is in the middle of the title of the model and has been the focal point of the discussions. These provisions in contracting and payment are certainly important for dentists, but they are ultimately important for the patient because they're the ones that are left absorbing those costs. Before we hear the final comments from the speakers, I would like to walk you through some of the changes in the bill. The first one's on page 108. And about halfway down the underline section, we just deleted this pre-treatment estimate, and maybe the speakers can explain this a little better, but in dentistry, there are 2 different things. There's a prior authorization, which means we authorized it and we agree to pay for it. And then there are these pre-treatment estimates, particularly when you're doing a pretty extensive treatment plan on someone, you'll submit a pre-treatment estimate just to get an idea kind of what will be covered, but that's not binding. So the bill is not about pre-treatment estimates. And we actually later on put a drafting note saying if you thought it was necessary to put that in your model bill for your state, that this prior authorization bill has nothing to do with pre-treatment estimates. The right below that, the prior authorization, let's see, it says, we're still on page 108. The prior authorization, we took out we added the word written, meaning the prior authorization has to be a written. They send you back an authorization number that you submit with the client, so it has to be in writing. Then the next change is on page 109, and It's the part 1B, we just, 1B1, we took out sold and leased. They wanted that removed. And then the next one is the underlined portion on, let's see, yeah, the next section is, yeah, it's the definition. We changed it to say, I'm sorry, we made some changes like, since the 30-day things were submitted. The next section says a provider has been changed to, if a provider opts out of lease arrangements, this shall not permit the contracting entity to cancel or otherwise end a contractual relationship with a provider. That changes to clarify the intent of the section. Also, some of the language in the drafting note below that section makes it clear that this section doesn't apply to leasing companies, which are in a different statutory section. What we want to make clear is that, that if you already have a contract with a company, they can't cancel your contract just because you don't agree to be leased, in other words. The next section is 1C1, and it's also the underlined section. It says third-party access provision, and we're replacing that with, if the contracting entity is an insurer, the third-party access provision of any provider contract shall also specifically state that the contract grants third-party access to the provider network, and for contracts and dental carriers that the dentist has the right to choose to not participate in third-party access. The reason for that change is mainly just to clearly identify is open in to interpretation, which could potentially be an issue if this language is adopted by multiple states that have different enforcement requirements. And then the other one's just the drafting note I mentioned that, that you wanted this. Oh, can you hear me?
No.
Oh,
Go ahead.
Oh, the other was just the drafting note I talked about that said that it's not a pre-treatment estimate, it's prior authorization. Then let's see, the next is on page 114, section D, 3, and that'll be deleted to make sure that there's no risk of sharing confidential information. This is about the credit cards. They send you a credit card, and then you had to pay to accept the payment. You end up paying a credit card fee. Well, we did want to say, are these insurance companies getting a kickback from the banks for sending you the credit card? But I think the banking people thought that was sort of a breach of confidentiality. So we're removing that you have to notify them if they're getting, a percentage of the payment to the credit card company. So we took that out on the request of the banking people. Lastly, a section will be included at the end of the model, providing the commissioner authority to promulgate rules that are consistent with the provisions of the act and the law of this state. Thank you, Madam Chairman. That's all I have. If we want to hear from the speakers.
Okay, thank you. First, we're going to have Chad Olson from the American Dental Association, followed by Teresa Cagnolati from NADP and Brenna Papard from AHIP. If you could limit, since we have had multiple conversations about this model, if you could limit your comments, please, to 2 minutes, I would appreciate it. Thank you. Go ahead, Chad.
Thank you, Madam Chairwoman. And my comments will be brief. I'm so pleased with the compromise language that we were able to reach with all the stakeholders involved. It's great to hear George Kaiser's voice, and I want to thank him for introducing this initially, and then Deborah Ferguson for carrying it forward. Looking forward to working with this body on some other issues that were dropped from the original model, because I think there's some space there to play. But I just want to thank everyone involved and look forward to answering any questions. Thank you.
Thank you. Teresa?
Hi, thank you. I just want to start out by thanking you, Pamela Hunter, the chair of the committee, and the Assemblywoman, the Vice Chair, Representative Ferguson, who's the sponsor of the Model Act. I also want to thank Representative Kaiser for his leadership on this issue as the original sponsor of the bill since December. As Representative Ferguson has pointed out, there have been a lot of changes. And finally, I want to thank the ADA for continuing the conversation and being so receptive to the input from the dental benefits industry. I've gotten to know Chad a lot better over the course of the last few weeks as we've spoken about a lot of the issues facing our two industries. And I think what has emerged from those talks is that we both have a common goal, and that's to ensure that folks have access to quality, affordable dental care. And I think this is what makes NCOIL such a great and important and valuable entity. It's that it brings folks like Chad and I together, and our two industries get a forum to talk about these issues. So they impact everyone at a national level, and we're happy to see the outcome of this legislation. We're glad to see, most of all, that this legislation has taken our Model Act has taken a thoughtful approach to leasing. There's a recognition, of course, that leasing benefits a number of parties, providers, carriers, as well as consumers. We do recognize that the language has been modified significantly, and where we all align, NADP, ADA, and the sponsors themselves, is that we all want more transparency. We want to make sure that dentists have choices to be able to opt out of the leasing network, and that they are well informed. So I think the bill accomplishes this. We do have one concern, though, with the language as it's currently written, and that's in 2 sections. You'll see that there are requirements during the contract renewal process. One is that a list be given to providers of all the third parties in existence every time the contract renews. And then the other is that the dentist be given the opportunity to opt out every time the contract renews. We think it's worth noting that these contracts generally renew on an annual basis, and that we've built systems up to make things easier for the providers and everyone that's involved in the administration by having this process occur in an automated manner. So we think that given that the model already requires that carriers inform providers of all the third parties in existence through a website that's updated every 90 days, and notify the providers of any new third parties that are purchasing the network 30 days in advance of even the purchase even happening, that the model is really achieving that joint goal that we have, which is to make sure that the providers are well informed without the requirement of this extra renewal language. So we'd like to see language referencing renewals be removed because of the redundancy around that. So I'd also just like to thank the sponsors, especially for what was initially said at the beginning of the introduction of this Model Act, which is there is a distinction between pretreatment estimates and prior authorization. We recognize that the model now has a drafting note that calls out that distinction, and we would like to thank the sponsor for including that drafting note. I think it's important for us as an industry to say that from our perspective, the most important distinction that we see between these two concepts is that a pretreatment estimate is a voluntary process, and that the estimate, it's non-binding. So just so we're clear, pretreatment estimate, it's an optional process. Providers and members can request information about benefit coverage and costs, and they can get the estimate. And it's not a guarantee of payment, and it's not a determination of the necessity of medical services. We hope that that can clear up any confusion that there might be out there. But we just really appreciate this effort to help patients and their dentists anticipate any cost related to dental services. And again, I want to thank this committee. I want to thank the sponsors, and I want to thank the ADA for all the work that's been done on this legislation. Thank you.
Thank you, Teresa. I just want to put out to my colleagues, legislators, if you do want to ask questions on this model, if you could go ahead and use your raise hand function. We will get to you after our last speaker, Brendan Papard, who is with AHIP. Brendan?
Thank you, Chairwoman Hunter, Vice Chair Ferguson. I too want to thank Representative Kaiser and Representative Ferguson for all of the work that has been done on this. We echo the comments that Teresa just made. I also want to thank the ADA for their willingness to work with us in good faith on compromise that I think has vastly improved the model. We do share the concerns that Teresa raised. I won't go through them again in the interest of time. I'm happy to answer any questions that you may have. Again, really appreciate all the work that has gone into this. We believe it's a tremendously improved model.
Thank you, Brendan. I'm looking at the raise hand function. I don't see anyone having their hand raised right now to ask a question. Do you have any last comments, Deborah, before we make the motion to adopt the model?
Madam Chair, this is Matt Lehman in the audience here. If I can, I just have a quick question.
Oh, sure, certainly.
I think as you're talking there, on the auto renewal, when you talk about there's been no changes to the third party plan, what is the reason for requiring that to be sent all over again? Maybe I missed that part.
Representative Ferguson, are you?
Oh, I thought he was asking Chad Olson, maybe Chad. might-
I can't answer. Yeah, Thank you, Representative Ferguson. So Representative Lehman, if I understand the question, it is, why would we want to do it on renewal? Does that boil it down?
Well, if there's been no changes,
Hmm.
I mean, it seems to me that you get a situation where there's been no changes and you've had prior renewals and now we're renewing it again and it requires to be resent. And I guess that's just the piece I'm trying to figure out.
Yeah, and the speakers, the stakeholders from the payer community did talk about how there's a little bit of redundancy. I would say two things. One is that redundancy on informing the providers of new relationships. The contract itself might not change, but new leasing arrangements might have taken place. It would be good to both have it on a website with notification and at renewal. More of these relationships are taking place than ever before. The other thing I'd say is that the renew language shows up in the statutes in California, Connecticut, Illinois, North Carolina, Nebraska, and New Jersey. So there is precedent around the country for renewal being another touch point for information.
Okay, and adding that, the part you said about new, not so much changes to the plan, but new members or new associates. That makes sense. So thank you.
Are there any other questions? Since I can't see the people sitting in Tampa, I'm going to ask to make sure that, Will, if you could let me know if there's anybody.
No questions here, Madam Chair.
Okay, hearing none, I'd like to ask for a motion to adopt the model as amended.
So moved.
A second?
Second.
Okay. Per our bylaws, all votes shall be voice votes, except that a roll call vote should be taken at the direction of the chair. So we're not going to do a roll call vote. I think that we'll just go ahead and do voice vote, unless there are any dissenting votes.
Aye.
So, okay, so we have a motion in the second. All in favor?
Aye.
Aye.
Any opposed? Abstentions? Okay, the motion carries. Thank you. Thank you, Representative Ferguson. I know you work really hard on this, and we've had many conversations about this model as well for the last several months. So I appreciate all of your hard work. Thank you. And thank you to the folks at ADA and ADP and also AHEP for working alongside us for these past several months. We're going to jump
Could I
right.
just say thanks to Representative Kaiser. I mean, it was really his bill, and I'm very grateful that he let me work on it.
Yes, thank you so much. We're going to jump into our NCOIL Telemedicine Authorization and Reimbursement Model Act. We have this model to go over and also the air ambulance patient protection model as well. I know we started a couple minutes late. We are going to dedicate about 30 minutes to each one of these. So we're going to jump right in and go ahead and get started. So if people are taking too much time speaking, I will jump in and kind of move you along because we want to make sure, since these are new models, our colleagues have an opportunity to ask questions. And thank you everyone for the work thus far in this model. I've had many conversations about telemedicine from doctors and insurance carriers over the past several months. And, quite frankly, constituents, as I'm sure all my legislator colleagues have as well, relative to some of the concerns about telemedicine. It is definitely a good work in progress, and I'm confident that we'll be able to get to a place where everyone can support it, and hopefully we'll be able to get there at our next meeting. Our invited speakers today are Joanne Volk of the Georgetown University Center on Health Insurance Reforms and Jennifer DeYoung of the United States of Care. They will be speaking in that order. We will hear from Brendan Papard of AHIP and Kimberly Horvath of the AMA after that. So if we could start with Joanne, please, and if you could, about 5 minutes, that would be wonderful.
Hello, thank you for allowing me to join the meeting today to talk about some of the research we've been doing on state laws on telehealth, coverage of telehealth in private insurance plans. Certainly all have noticed that use of telehealth has jumped dramatically. I mean, pick your estimate. There's one estimate that says up to 1 billion visits this year. And we talked to an insurer that said they covered more in April than they did in all of the previous year. And certainly about 24 states issued temporary bulletins or emergency orders from their departments of insurance under the state's public health emergency authority to relax standards that were in place and encourage greater use of telehealth, not just for, not just related to the COVID care that was required to be covered under various federal legislation, but also to encourage social distancing and keep people safe. And we thought it would be a good time to go back and look at what book laws were on the books previous to COVID and just see how those mapped out the protections and what needed to be changed for COVID, and whether or not states were looking at revising their statutes when this is all said and done to update them for a world in which we've jumped both feet into the telehealth world. So to do that, with funding from the Commonwealth Fund, we're conducting a 50-state survey right now, looking at state legislation or laws in all 50 states, and going to come up with some themes that I can share today, some preliminary data. We also talked to regulators in 10 states to hear what they were hearing with their temporary bulletins and use of telehealth in their states. So I want to just share some themes that we've seen in our 50-state look at the legislation. About 36 states already require coverage of telehealth visits on par with in-person visits, generally saying if it's a covered service and is provided via telehealth, it must be covered or cannot be denied just because it was covered as a telehealth visit. The next most common feature is about 24 states require parity in cost sharing, that the insured cannot be charged more, and in some cases might say they must be charged less for a telehealth visit. Less common, but still substantial, about a dozen states require parity in reimbursement to providers. It can be no less than what is provided for an in-person visit. And then there are a handful of states that have addressed other smaller issues. For example, you can't restrict the medium that is used. This is where the audio only comes in. A requirement to have prior relationship, or to limit the point of origin, and generally to broadly define that to say anywhere where the patient is in their home, for example, is a legitimate point of origin for qualifying as a telehealth visit. The temporary orders or bulletins under the state public health emergency authority, some of them were just reminding issuers of the laws already in the book. Some were merely encouraging, though not requiring, issuers to take specific action to encourage greater use of telehealth. But about 24 states actually did either relax standards or suspend certain standards that were in law prior to COVID. And the common themes there were to either limit or entirely eliminate the cost sharing for consumers, to expedite or eliminate or even prohibit the use of prior authorization for a telehealth visit, or to remove other conditions that might limit access to telehealth, for example, to require a specific platform or medium. And this is where a lot of states said specifically, you have to allow audio only. There are many state statutes that did not allow for audio only, and this became a critical piece of the temporary orders, recognizing that not everyone has broadband access or the right devices to do an audio video visit. And frankly, it was also pointed out that for behavioral health, the greater needs for behavioral health care at this time, that some people felt more comfortable with an audio visit for that care than a visual. And the other conditions that were waived often were that you had to have a prior relationship with the provider, or some states would limit the requirement to cover telehealth equal to in person if it was with an in-network doctor, or even in some cases provided through a telemedicine network. It was not required of all providers in the network. And then another common feature of some of these temporary orders was that reimbursement cannot be lower than for in-person. Going forward, looking at whether or not they might put new laws on the books or revise the ones that they already have, we definitely heard that where there were these temporary measures around reimbursement, that's going to be one issue that will need to be addressed by the legislature. There were a number of states that had it on the books already, and it was not an issue. There was no pushback from the time it's been on the books. But for those states that previously did not require it, but did for COVID, this is going to be something that's going to have to be settled via legislation. We also heard great recognition that audio only is now seen as long-term essential too. It's not just something to allow for during COVID, that this seems to be something that rises to the level of an update that's needed for longer term use of telehealth. And then we also heard about various ways that states are collecting data to understand how this is working out. In a number of states, the legislative efforts that predate COVID really were led by state legislators, often providers in the legislature, pediatrician, for example, in which case there were standing work groups that have been working on this year to year, and these updates were sort of just slotted into that process. Another Department of Insurance that we talked to held a data call with insurers to get some data from them about what they're seeing in terms of use. And then others tapped into existing work groups, whether it's standing work groups with primary care providers, or another talk to their coalition of mental health providers and consumer reps to hear about use of telehealth for that community. But the one clear benefit that we heard throughout was that there are fewer missed appointments with telehealth, and it's really been a benefit to maintain access for people, particularly those with chronic conditions who need regular visits, to be able to do that virtually. And I can stop there unless there are any questions. I know you're trying to get through a bunch of folks.
We'll do, thank you so much. We'll take all the questions at the end.
Okay.
Thank you so much. We're going to go to Jennifer DeYoung from the United States of Care, please.
Hi, thank you. And I have a couple slides, and let me try to share my screen. Give me 1 second. All right. Can folks see the slides? We're good? All right, great. Great. Well, first off, just want to say thank you very much for having me. I'm Jennifer DeYoung, United States of Care Director of Policy, leading up our Building Blocks of Health Reform initiative. For my time today, I will be brief, but wanted to first give you a little bit of background on United States of Care, and then share a little bit more about our interest in virtual care, specifically in the work we're doing in this space, and then offer up some guidance on what we're seeing as critical for creating long-term policy on virtual care. So with that, to start, United States of Care is a nonprofit, nonpartisan organization with a mission that is both bold and simple, that everyone in the country should have access to affordable health care no matter who they are. And specifically, our goal, our contribution towards the broader mission is intentionally twofold. First, to expand access to quality, affordable healthcare in the near term. And second, to pave a path towards durable, people-centered federal policies that achieve our mission. A key element of our strategy is bringing different perspectives to the table to solve problems. We see our Brain Trust, our Founders Council, Entrepreneurials Council, Voices of Real Life, and our bipartisan board of directors as our unique superpower, which sets us apart from other organizations working in this space. We also play a unique role by focusing first on where people are and what they're experiencing in the healthcare system. We take time to listen, to understand what their experiences have been like, and then we use that information to help inform the solutions that we put forward to solving pain points in the healthcare system. This year, we've launched a new body of work focused on virtual care. As we have all seen, the COVID-19 pandemic has brought into light the long-standing problems with our healthcare system, including equity issues around disparities. For example, how some people like Black or Hispanic American gets unequal access to care. And at USF Care, we see that there is a window of opportunity now to make meaningful, lasting changes to our healthcare system, to make the system work better for all people over the long term beyond the pandemic. With virtual care, which we are defining as including telehealth, remote monitoring, other remote forms of communication, we're interested in understanding how much virtual care is more than just another shining new tool that's out there, but rather how it's helping to close gaps and get more people access to the care that they need. So to get at this, we're starting with first understanding the patient's perspective, and we're doing this by holding a national listening tour right now with people, providers, and other key stakeholders to learn about their diverse experiences with virtual care. And then we're going to pair that with what we learned from people and what the research evidence and experts know, so we can see what's missing with virtual care and what more can be done to ensure virtual care is working for everyone. If you go to our website, you can see a couple of the products we put out so far, and we'll be adding to that in the coming months. But what I'm excited to share with you today is more on what we are hearing so far from people and what we're learning in our research of evidence. All of this is critical to helping inform how to create policy so that we can ensure policies focus on what people need the most. We recently fielded a national survey at the end of November to 1,000 registered voters, where we asked questions about people's experience with the healthcare system overall, as well as virtual care specifically. And as you can see, 44% of respondents overall have received virtual care, most doing so as a result of COVID-19. And we know a little bit more about those who used the virtual care. About half of those who received it identified as Republicans and half as Democrats. 59% of people with a disability said they used it. 73% of those who had used it said they had a mental health disorder. Overall, we found that there's wide support for the convenience of virtual care, especially during the pandemic. 87% had something positive to say about the virtual care experience, and 72% appreciated the convenience of not having to leave their place of residence to receive care and the ease of scheduling. However, many respondents have questions about the accuracy of care and concerns about the use of technology. And this aligns with what we also heard in our one-on-one interviews as well. For example, one older adult that we interviewed said, "I would not explore virtual care if I had to do it on my computer or any other way than a phone call, because then I would need help from other people, and I believe that healthcare appointments should be private." Additionally, another point that we find to be really insightful is understanding why people are not using virtual care. According to our poll, of the 53% who had not used virtual care, 16% had not done so because they felt it wouldn't be personalized or meet their specific care needs. In our focus groups, we also had several participants question whether they would receive subpar or more impersonal care if not done in person. And these are important points to consider as virtual care policies are formalized. How can we retain what's working while addressing what isn't? So to complement our poll, we also have combed the existing research evidence to understand what other researchers are saying about the barriers people experience with using virtual care. There's a lot on this slide, but what I can tell you what it says is that it lists out the categories of key barriers that underserved populations experience accessing virtual care. And as you read through the list, you'll see that some are shared across different populations, while other are barriers that are unique to certain population groups. If we're going to take this unique opportunity of virtual care and design it in a way for the long term so that it helps to get people access to care who in the past have struggled the most to get the health care they need, then we need to pay attention to these barriers, what's creating challenges for people now, and address them in the permanent policies. As all of you and other policymakers evaluate next steps for virtual care and consider making permanent the existing emergency actions, it's critical that policies are evaluated against criteria that place the needs of patients at the center. If we want to see people getting in to get care when they need it, rather than waiting until it's an emergency, whatever critically appropriate, patients must have the flexibility to choose how they would like to receive their care, whether it is in person or through any of the multiple virtual modalities. Permanent virtual care policies should address barriers people experience in accessing virtual care so that virtual care is a viable option for them. The committee should have a copy of US of Care's comment letter recommending some amendments to NCOIL's Telemedicine Authorization and Reimbursement Act. And these are places where we identified opportunities to strengthen the act to ensure barriers people experience are addressed. And I'll just end with one more point, that the increased need for virtual care across all populations due to COVID-19 has demonstrated to us just a baseline of virtual care's potential capabilities to help achieve better care and address longstanding inequities in access. And by putting the patient first, permanent virtual care policy measures have the potential to close gaps in healthcare access. And with that, I thank you and welcome questions at the end.
Thank you, Jen. Next, we're going to hear from Brendan Papard of AHIP.
Thank you again, Chairwoman Hunter, and also Vice Chair Ferguson. As we've previously testified, health insurance providers are supportive of the appropriate use of telehealth to provide access and to reduce costs to necessary medical services for our members. At the last hearing in September, we also testified on the specific aspects of this model, several provisions of which we are supportive. However, at the time, we noted that there are some provisions we have concerns with, and we also provided a red line of the model with our recommended changes, which hopefully all of you do have. As noted, we believe that health insurance providers should have flexibility in the design of benefits. There is language throughout this model that limits that flexibility, and we recommend its modification or removal. We're also specifically concerned with requiring equivalent telehealth and in-person payment rates. This eliminates the cost-saving potential of telehealth and, as we've testified in detail, can create inadvertent disincentives. I'm not going to review all of those arguments again here now. I'm happy to answer questions specifically during question and answer, but in order to save time, I will skip that recanting of those. I would note, however, there was a recent NGA report, which I did not have the last time I spoke, which includes the perspective that there are efficiencies in telehealth, making it a lower cost service, and that requiring payment parity misses an opportunity to lower costs. One other note, I've heard, though AHIP reads this model to require payment parity, we've heard that there are some that are suggesting that it does not in fact do so. If there is a belief among the committee members that this model does not require payment parity, and a reluctance to remove the language we've identified, we would request an amendment that specifically states that this model does not require payment parity. Thank you again, Chairwoman and sponsor, and I am ready to answer any questions when you get to that point.
Thank you, Brendan. And next, we're going to hear from Kimberly Horvath from the AMA.
Thank you so much, Chairwoman Hunter. Really happy to be with you today, and I'll be brief as well. The AMA supports, just to reiterate some of the information that we provided earlier, and actually to provide some new information to the committee as well. The AMA continues to support fair and equitable payments for telehealth, which will help advance the investments in telehealth by physician practices across the country. Since the committee last met, there have been some results from a telehealth impact survey of healthcare providers, which was performed by the COVID-19 Healthcare Coalition. The survey provided some really important findings, and I'll just underscore 3 of those today, but they really did provide lots of findings in terms of quality of care, patient experience, cost, and professional satisfaction, as well as some barriers and challenges to telehealth. So happy to provide a copy of the survey to all of you and the findings, but wanted to just share 3 details from the findings with you today. First, over 75% of clinicians responding to the survey indicated that telehealth enabled them to provide quality care for their patients for COVID-19 related care, but a whole range of care as well. More than 80% of respondents indicated that telehealth improved the timeliness of care for their patients. And a similar percentage of respondents shared that their patients have reacted favorably to telehealth, much what Jen just offered. And then also of importance to the discussion on payment, more than the biggest challenge that respondents indicated for having telehealth move forward was low or no reimbursement. And that was, again, identified as the biggest challenge or barrier to maintaining telehealth post-COVID. And 73% of respondents indicated that was the case. So this is really a key reason why the AMA continues to support equitable payment for services provided via telehealth. And that really does mean that when the services are comparable or commensurate with those services provided in person, that the payment should be the same. Joanna did a really excellent job of providing an overview of state law, so I won't go there. We'll just reiterate once again that, as we continue to promote innovation and as we continue to see value of telehealth moving forward, and as physician practices continue to make significant investments in telehealth, that there needs to be certainty moving forward in those reimbursement models. And just also to end with one thing, just to let all of you know that, clearly telehealth has become increasingly important during this pandemic. There is a growing recognition that there are potentially long-lasting benefits and value to the continued use of telehealth in terms of clinical outcomes, in terms of access to care, as well as the patient and provider experience. And we at the AMA continue to do research here, and we'll continue to share that with groups like NCOIL as that comes to fruition. So thank you for your time.
Thank you, Kim. I know Senator Hackett has a question. I'm going to jump in first. But if there are any colleagues who are interested in asking a question to any of our panelists about this telehealth model, please use the raise hand function on your computer. First, I would like to ask, Section 5 of this model talks about allowing out-of-state providers access to compete with in-state providers. And I know I've had some conversations with some providers saying that, it's not equitable, and that they want to make sure that people are allowed to see somebody in state and as far as competition. So does anybody have any comment relative to that?
I can jump in since we support that provision, but I'm sure Kim will probably have I suspect she'll have a contrary view. We believe that that provision allows for expansion of access, and we think it's one of the very good things that has come out of, I hesitate to put it that way, but that's come out of this experience, seeing that expansion happen related to a lot of these emergency orders. And it's important to note that the carriers, when they offer telehealth as a benefit, do make an effort already. In fact, where it's required, they already offer the ability to speak to providers who are in the state. And so I don't know that I understand the concern that there wouldn't be availability to speak to providers in state. You may be getting at a question of whether
I think it's from the providers who are worried that out-of-state practitioners, because telemedicine is available, that basically they could jump in and take their patients.
Yeah, I mean, I'll let Kim talk to that. I don't think we view it that way. That's certainly not our intent in making it an available option to increase access.
Okay, thank you. Kim?
Thank you, Chairwoman. So I would just add that the AMA continues to support state-based licensure and the Interstate Medical Licensure Compact as the path forward in helping physicians in particular, right, because that's obviously the physician compact, that are interested in practicing across state lines. There's a really good reason for maintaining state-based licensure. Reasons like, obviously there's various state laws that all of you have put in place, right, that you want to make sure that are applicable and continue to remain for your constituents, things like age of consent and those types of laws. It's really important to maintain the state-based licensure structure to make sure that the patients in your state are protected, and making sure that physicians and other healthcare providers in your state are licensed and have oversight from the board of medicine that is of the state in which the patient is located.
Thank you. I just have another quick question before we go to Senator Hackett. I think this might be for Jen, but when we had an opportunity to do the fly-ins with the congressional folks, I don't know, it could have been a month, 2 months, I don't know, COVID time, it could have been a year, 5 months ago. But we spoke to the congressional folks, and one of the biggest things that I have seen an issue, especially where I live in central New York, is infrastructure, and all broadband Wi-Fi, access is not the same. And presuming that just because someone has a smartphone doesn't necessarily mean they have FaceTime or data in order to, make them able to really have a substantive telemedicine appointment. So I guess I'm putting out there, and I don't know if any of you are, advocating to, the congressional folks or even at state level folks, that without that kind of broad infrastructure investment, that really the accessibility for telemedicine will not be for those populations of people who have the biggest barrier to access to healthcare. So I just didn't know if any of you had a comment about that.
I'll just say, I guess that what you're saying is showing up in people we're listening to, as well as the research we're finding. And I think that's why we are, leaning into having the availability to continue to do telemedicine visits over the phone, because for some people, just having the infrastructure or lack of smartphones to be able to access a provider is a barrier. We are part of a larger coalition called the American Connection Project that is being led up by Land O'Lakes, to actually do exactly what you said, to examine and look for and push for a broader broadband access, particularly in the rural communities throughout the US, because I think in order to reach a lot of our rural communities, we need to have that stronger infrastructure.
Thank you. Senator Hackett.
Let me unmute myself. And one of the questions was your question is great. In Ohio, we're trying to increase the broadband, because you're exactly right. I just tell the people, I've had 3 telehealth appointments. And one of the things we found that you're right, all you need was smartphones. Even the providers are realizing, I told Kim in the AMA that we're really using it tremendously. And providers are, no one forecasted the amount of visits we'd have in Ohio. No one was in 50% of the forecast. It's amazing what it's done. But Kim, the only thing, the question I have to you is, I'm for coverage parity, but, most every provider that I know, except for certain specialties, say that telehealth is cheaper. So there is a cost savings of using telehealth. So why should not the consumer share in the cost saving? We've never controlled healthcare costs. So why should not the consumer? Just think of how many people are not going to the emergency room now, when they shouldn't be going to the emergency room in the first place, should be going to the doctor. And now they're going to telehealth. It's just tremendous how it has worked out in Ohio. So that's my first question is why, when there is savings, there's dollar savings, why should not the consumer share in those dollars? Why should they go to the provider?
Sorry, I thought there was going to be a second question, so I was writing that one down quickly. You're right. There is a value to telehealth, and I think that what we are trying to do right now is, because we have this opportunity with all of the proliferation of telehealth over the past 10 months, we have this really unique opportunity to look at the data and find out what that value is. But I do think that we need to be cognizant of the fact that there's an investment as well for physicians and other healthcare providers as they are implementing this into their practice. There's an investment in their electronic health records and making sure that everything meets the standards required, and making sure that everything is connected. And certainly the cost and comparing it to in-person visits is again something that we're looking at as well. And so at this moment in time, but I think what we're looking for is consistency for healthcare professionals as they are providing and implementing these services, these telehealth as part of their services they provide to their patients. We want to make sure that they know moving forward and have recognition moving forward that payment will be commensurate with what they receive as in-person services, and helping make sure that they can sustain the services of providing these services via telehealth.
So, but that's why in Ohio, and I don't just totally disagree, because in Ohio, we went ahead. I mean, one of the reasons to have a telehealth bill was, and you heard the professor speak about, a lot of the orders were temporary. Well, ours become permanent by budget way back January, but they weren't sure the pandemic was going to last that long. Now we know it's going to last. But we did put in Ohio that it's up to the plans and the provider to negotiate. And you're 100% right on certain specialties. They do have an investment and they have to do things a little differently. But on a lot of the areas of telehealth, the investment is minimal. I mean, I didn't tell you, but those 3 visits I have were with a specialist, and it still was iPhone to iPhone. And so, I mean, any tests I had to do, he either ordered or, I'd do somewhere else, or I had the oximeter right there at home and the blood pressure right there at home. And so I just think, it's something that needs to be negotiated, but you can't just I think it's a mistake putting the law that it requires premium parity. I know states are considered and some have done it. Ohio won't do it. But the one thing is, we're not going to codify the rules, because it's all in rules now. With Medicaid, everything is in rules. We're not going to codify the rules till we see how telehealth settles after the pandemic, because you have to agree with that. Will those people go back to the emergency room when they can? Well, we don't want them to, but we'll wait and see. But that's the only thing I want to tell you is this: the scenario of it is the investment cost. We agree, and I think the insurance plans have learned that certain people need to be paid parity. I agree with that. Certain specialists, but certain ones, they'll be the first to tell you it's much cheaper with telehealth from the provider. So that's why let it be negotiated between the plans and the providers on their network charges. Okay.
Thank you, Senator. We
Oh,
have
sure.
3 more questions and about 5 minutes for the rest of this topic. So can we get Representative Kaiser, your question, please?
Thank you, Madam Chair. We sometimes operate like telehealth is brand new, and it's at least 30 years old. We've had organizations like Nighthawk doing reads on radiology from India, Australia, wherever, because we have radiologists that don't want to come in at night or on holidays. And as a result of those reads, we do surgery and everything else. And then the following Monday, when the local radiologist goes in, they reread it. And there's only one reason they reread it, and that's billing.
Yep.
And so my concern, I accept that accessibility is going to increase dramatically. Cost is going to increase dramatically because we're utilizing a system more. But what are we going to do in terms of parity of payment to a physician? I'll pick on a dermatologist. I don't know why, but they do it. They scan it. They look at you and they say, "Yeah, that looks like a problem. I'm going to have you come in so I can see it." Do they get the bill 2 times the same amount? Where's the parity?
I don't know if that's a theoretical question or one that we can tackle at our next conversation. Maybe something for folks to be thinking about as we're having this parity conversation. Let's go to Representative Ferguson, and then we'll end with Assemblymember Cahill.
Representative Hunter, I could just give a quick answer to that hypothetical. We are seeing that double billing in Medicare already.
Okay, thank you. Representative Ferguson.
Yeah, I guess I sort of have a question more for the committee. I'm unclear why providers would say it's cheaper for them. I mean, when I'm talking to my providers, they're spending the same amount of time, and they're all different levels of office visits. If you look at your EOB, they should be charging you for the minimum level office visit because they're not able to do exams and tests and those kind of things that they would do in person. So I mean, that's the reason I'm for parity. They're spending the same amount of time and they should be billing a lower level CPT code. But that said, I think all of us going forward have to really not fall into the trap of thinking that everything that was an emergency order during this pandemic is appropriate care going forward. Much of it has been compromised care. I mean, some of it's great. A lot of the telemedicine's great, but I mean, I already see bills coming to my session next time wanting to do everything we've done through emergency orders. And a lot of that is compromised care. So that's just my comments. Thank you.
Thank you.
If I could just answer her question, it's just the fact alone that the percentages of appointments being held are tremendously higher. So you talk to the providers, they will tell you that the chance of the people standing them up is a lot better. The second thing is the travel cost to provider. There's so many other things. I'm not talking about specialists. I'm talking about primary care physicians. They will tell you it is cheaper to do telehealth than it is to travel, and the people will show up. They'll be there for the appointments.
Well, I mean, it's the doctor's not traveling. The doctors that are doing telehealth, they have a room, a telehealth room, and they're scheduling the room just like they do for regular appointments. And they go to that room and then see telehealth appointments. So their time is equal. I'm not sure where I'm not sure how they're rationalizing it's less expensive, but.
We obviously have much more to discuss over this model. So let's close with Assemblymember Cahill.
Thank you, Assemblywoman Hunter, and thank you, everybody, for this very important topic. I agree both with Deborah and Bob on the 2 points that they raised, but I also think the third point that was discussed earlier is important to continue to consider. I would rather see us let this marinate a little bit while we continue to get our way through the crisis, see what comes out at the other side, see what emergency regulations states have promulgated for better practice examples, see what other legislative proposals come down the pipeline. Certainly, we should continue to offer guidance. We should determine whether there needs to be a distinction between audio and audio-visual visits. We need to determine the question of duplicate billing for the same episode that may require 2 instances of a telehealth or a telehealth with a follow-up. But I'm mostly concerned about getting right the reimbursement issue. The reimbursement issue will determine the incentivization of delivery of healthcare, and that's really what we have to remember. That when we make a decision about the economic relationship between entities, we are actually making a decision about how those services get provided. The last and other particularly troubling point that I have is on Section 5, the limited telemedicine license. Assemblywoman Hunter, as you know, we in New York State take our licensure of professions very seriously. We don't do it in the Insurance Committee. We do it in the Higher Education Committee, and the competition between providers for scope of practice and also protection of title and those sorts of things is very fierce. And I'm not certain that a practitioner in another state would have the same scope of practice, or that a title in another state would match with that of our own state. And that is something that has to be reconciled. So I would support the concept of continuing to use the existing waiver processes and adoption processes in the departments of health of our 50 states. But having said that, I think this is an important model for us to take up again very soon. And I would urge all to consider the points that were raised here today to refine this and maybe get this camel through the eye of the needle eventually. Thank you.
Thank you, Assemblymember Cahill. We will be having conversations about this again at our March meeting. You know, that's obviously right around the corner through the holidays. And so I don't expect we'll have a final in March. And as the Assembly member noted, we don't know what's going to be happening through these next several months. So it probably be more likely July. So I appreciate all of those who had forwarded comments. We do have your comments. We do have your red lines. You know, continue to engage with me and NCOIL through this process. And we'll make sure to get any forwarded amendments out to committee members. So thank you for that. We are going to, and thank you to all of our speakers for this panel. We're going to jump right into our introduction and discussion of the Model Act regarding air ambulance patient protection. And this will be sponsored by Representative Oliverson. And I have conversations with Delegate Westfall. The folks speaking today are Chris Myers from Air Methods. We have former Texas and South Carolina Insurance Commissioner Eleanor Kitzman on behalf of Global Medical Response, and we have Oklahoma Insurance Commissioner Glenn Mulready to speak on this model as well. So do we have Representative Olerfison?
Madam Chair, I'm here. Can you hear me?
Yes, I can hear you.
Wonderful. Thank you, Madam Chair. Pleasure to join you guys briefly today. I apologize I'm not there with you, but I'm very excited to introduce this Model Act along with my colleague, Delegate Westphal. I'm not going to take up too much time, Madam Chair. I just want to say that the model is very straightforward. And the ultimate goal is to regulate the subscription membership products for air ambulance as insurance. I think we're all familiar with the phrase, if it walks like a duck and it quacks like a duck, it's a duck. And that's really where we're coming from with this particular model as we attempt to regulate these subscription products as insurance. And Madam Chair, that's all I have, and I'd like to turn it back over to you.
Thank you. It's unfortunate not to be able to see everyone in person. It's great to see everyone via Zoom, though, as well here today. Delegate Westphal for comments.
Yes, thank you, Madam Chair, and thank Representative Alverson. I'm very proud to sponsor this Model Act along with you. I won't take much of your time, Madam Chair, but I completely agree with Representative Alverson's remarks. I just say that I think the air ambulance membership product, we're started with good intentions, but the landscape has changed and memberships have become less prevalent. At this point, become problematic because patients really don't need them. Membership is supposed to cover the balanced billing portion of a patient may receive if the insurance doesn't pay. However, this has become less of a problem because of the gains of network participation. Also, there have been some complaints that have been marketed in a way to sold to people who don't need them. I'm looking forward to working with the Model Act with everyone and looking forward to see everybody in person as soon as possible. Thank you, Madam Chair.
Thank you, Delegate. First up, we have Chris Myers from Air Methods. Then the commissioners, if we could limit your comments, please, since we want to make sure that we get to our Q&A to 5 minutes maximum. I would appreciate that. Chris Myers.
Okay. Chair Hunter, Vice Chair Ferguson, thank you for your time today to address you and the committee members on this really important topic. I'm joining you today representing Air Methods Corporation in support of the Model Act regarding air ambulance patient protections introduced by Delegate Steve Westphal of West Virginia and Representative Tom Oliverson of Texas. Air Methods serves 49 states with over 400 helicopters and fixed-wing aircraft, representing over 65,000 time-sensitive transports a year. When called by an independent physician or first responder, we have an asset deployed with our highly trained clinicians and pilots within less than 15 minutes. The most common conditions that we treat are trauma, cardiac, stroke, and respiratory stress, where minutes matter to the outcome of a patient. During these unique times, we have transported over 4,000 COVID patients as well. As rural hospitals continue to close, we are the last line of defense to get patients to the Level 1 Trauma Center to best serve their needs. Over the last 4 years, Air Methods has deployed multiple strategies to make the patient billing experience as transparent and as simple as possible. Our guiding principle is to approach any billing concerns according to what is best for the patient. To that end, we have aggressively pursued in-network agreements with any willing payer, which has resulted in us having 50% of our privately insured patients covered by in-network agreements with great partners like Anthem, Humana, and most states' Blues plans. This is up from only 5% 4 years ago. United, Aetna, and Cigna remain the final opportunities for us to be 100% in network. Being in network is the best way to remove the financial burden from patients and ease the reimbursement process. Additionally, we have deployed patient advocates that are individually assigned to patients with an out-of-network payer and a robust financial assistance policy so that the average out-of-pocket for all patients is $167 and getting lower. We do not balance bill patients and only send patients a bill if they have never provided us a payer of record or communicated with us to qualify them for financial assistance. up to and including 100% relief. Air Methods supports Delegate Westfall and Representative Oliverson's Model Act because it aligns with our patient-centric approach and protects patients from unscrupulous insurance and insurance-like products and related practices. Many membership sales tactics feel like being both arsonist and firefighter, where consumers are scared into thinking they will have a big bill and therefore need to buy a membership to avoid this imminent peril from the same company that is transporting them. This is the opposite of providers working to truly take the patient out of the middle. The overwhelming majority of air ambulance transports are for Medicare and Medicaid beneficiaries today who have a defined fee schedule and copay. Medicare patients are disproportionately marketed to with tactics like, quote, senior pricing. The prevalence of these products being sold to seniors is cause for question about whether regulation is needed. If only 25% of the 3 million Air Medcare network memberships are sold to seniors, this would make it the second largest Medicare supplement product in the United States. The lack of regulation of these membership programs today has created financial opportunists like Helimedic, which launched a website selling memberships but has no verified operations. It claims to cover the entire country in only minutes, with only a few helicopters based out of Texas and California. Additionally, when you attempt to call the posted contact number, it connects to no one, yet they are still trying to sell ambulance memberships at $500 for an individual or $1,500 for a family, even garnering local news coverage. From a utilization perspective, there are approximately 360,000 air medical transports a year, which represents 0.11% of the US population. Given the extremely low utilization of air medical services, one wonders why there are millions of annual memberships sold each year. Additionally, 80% of our transports are covered by a set fee schedule. Given this dynamic, Air Methods has chosen to apply resources to mitigate any patient out-of-pocket expense to the patients that actually need it versus those that do not and will likely never need it. I will leave it to others smarter than I am to conclude whether you believe memberships are insurance products or not, but a simple definition from Black's Law Dictionary states, quote, insurance is a contract by which one party, the insurer, undertakes to indemnify another party, the insured, against risk of loss, damage, or liability arising from the occurrence of some specified contingency, end quote. And borrowing from the Guardian Flight versus Gottfried opinion, quote, if a bird looks like a duck, swims like a duck, and quacks like a duck, a reasonable person can conclude that it is a duck, end quotes. Montana, New York, and Connecticut and Wyoming have all decided to regulate memberships as insurance, and Florida requires licensure, regulatory oversight as an insurance product to sell to Florida consumers. Patients and consumers should have full transparency and understanding of the product they are purchasing and not have their care compromised or face unexpected bills. The arsonist and firefighter sales tactic utilized to sell air ambulance memberships puts undue pressure on patients and doesn't fully disclose the financial terms of the insurance product they are purchasing or the fact that it isn't needed. Patients have sued membership for providers for balance billing them when the patient has received a legal settlement and the membership provider has tried to collect those funds. Uninsured patients may not necessarily understand that per the contract terms of some providers, they can be billed the Medicare allowable rate, which isn't covering their out-of-pocket costs. The one point that contract membership terms make abundantly clear is that they only cover the patient in the scenario where that specific provider transports them. This creates unnecessary and dangerous pressure on the patient to delay their care and wait for the free air ambulance transport. This is a risk that patients who need time-sensitive air ambulance transport cannot afford to take. At Air Methods, we've chosen a decidedly different path to memberships. You do not have to pay us a membership fee to do what is best for the patient. It is part of the service we provide. Thank you, Chair Hunter, Vice Chair Ferguson, and committee members for the time you have provided me today.
Thank you so much, Chris. We're going to go to Oklahoma Insurance Commissioner Glenn Mulready next. Commissioner?
The primary role, NEIC, insurance commissioners, consumer protection. Some of those items that we're concerned about, consumers do not understand the limitations. They're sold to people who do not need it. They have other coverage or through Medicare. Sold to folks who cannot use it. Maybe they don't live in that, the service area is too big. Consumers are unaware of cancellation policies, overstatement of the need. And even the industry, as you just heard, agrees with some of that, and lack of review of rates, forms, marketing materials, et cetera. Who's regulating that? Some states that have acted upon it, again, you've just heard some of that, but banning subscription services in North Dakota, where a federal judge ruled that the states do have the authority to regulate subscription plans as insurance. New York and Wyoming, where they're regulating them as insurance. Montana requiring certification. And there was legislation passed in Texas requiring reciprocity between subscription services, but indeed that was vetoed. Other options that are under consideration with states: banning the duplication of coverage and or standardize the plans, regulate sales, including disclosures, notifications, practices. And on that note, the Department of Transportation is looking at the subscription issue. Several reforms to apply to subscription memberships include requiring disclosures, only participating carriers only provide service in certain service areas, requiring they notify that you must be insured and the service must be a covered benefit, clarifying who does not need it. That may be in-network, Medicare, Medicaid, also other factors like age, size, conditions, weather, and other limitations. Provision of insurance of information on complaint dispute resolution and submission of rates, coverage data, and financial information. And finally, I think a key point that we would need to make is that this is, as I mentioned at the beginning, I think Representative Alston is on a good trail, but we think the overriding issue is the balance billing within the air ambulance industry. As you know, there was a bipartisan bicameral bill that was the agreement that was reached in Congress in 2019 that would have set some parameters there, would have kept state surprise bills in place, was adopted by a number of committees. But then when the House Ways and Means Committee adopted their bill that did not set a baseline, it stalled out. While the NAIC has been involved in the debate over the amount, we have not been involved in the debate over the amount insurers should be paid. The NAIC has sent letters supporting the extension of protections to air ambulance consumers and preservation of state surprise bill laws. Additionally, on the issue of air ambulance balance billing, the Department of Transportation appointed the Air Ambulance Advisory Committee, which was required by the FAA Reauthorization Act of 2018 to look at air ambulance costs and transparency. Commissioner Gottfried, who I might just make a plug for the great job that he has done on this issue and continues to be a strong leader on that, he was appointed as the state regulator. Their report and recommendations should come out sometime next year. In addition, the Department of Transportation has requested comments on the need and ability of the department to regulate air ambulance carriers under current rules which prohibit abusive practices. The NAIC also submitted comments urging the department to act to protect consumers from abusive balance billing practices. There's no time frame for this, though, for further action. Thank you, Madam Chair.
Thank you, Commissioner. For anyone who wants to ask a question, again, I'm going to ask you to use the raise hand function. Our last panel speaker will be the Eleanor Kitzman, please.
Can you hear me?
Yes.
Great. I'm Eleanor Kitzman. I'm an insurance regulatory consultant in Austin. I represent Global Medical Resources, or GMR, in connection with this proposed Model Act. There is a presentation, but I understand that those of you that are on Zoom may not have been able to pull open those slides. So my apologies. It's my understanding that it will be on the NCOIL website. It's a short presentation, and included in it are some slides about GMR and its services and its footprint, which has grown dramatically since we last appeared before you in connection with the Model Act regarding air ambulance insurance claims that was adopted by the Executive Committee in November 2017. For those of you who have the presentation, I'm going to jump ahead to think it's slide 5, on membership programs. But first, I want to say that we too are very disappointed that the Model Act was not able to be enacted in any state, and that the surprise or balance billing issue is still with us. You know, there is a surprise billing proposed legislation in Congress. And again, you know, it's my understanding as well that the Department of Transportation Advisory Committee will be issuing guidance soon that may include some of the NCOIL model concepts. And as welcome as that will be, balance billing and membership programs are two very different things. And GMR believes that its membership programs represent a good value for many consumers and may be an even better option for many consumers. GMR operates the Air Care Med Network, or AMCN, which is the largest membership program in the U.S. with 3.1 million members in 38 states with 320 locations. Membership ensures that members have no out-of-pocket expenses if flown by an AMCN participating provider. AMCN does not market in areas where it is not a first or second call provider, which means that it's considered a go-to provider based on its service history with the dispatchers, and that it receives a significant number of transport dispatches in that area. The website coverage map indicates whether coverage is available based on a consumer's zip code. AMCN memberships are distributed through 3 channels. There's a direct to consumer, which includes direct mail, digital, and attendance at events by sales reps. There are employer sponsored programs with payroll deduction, and then municipal site plans, which counties, cities, or other local jurisdictions pay to enroll residents for basic coverage, which may have defined geographic or other limitations at the discretion of the local jurisdiction purchasing the plans, but residents of that area are offered upgraded coverage at a discounted rate. There are currently these municipal site plans in 20 states. The next slides are the AMCN application and the terms and conditions. And I want to draw your attention to a few things on the application. First is the Section 2, which asks for the names of all members of the household. This is because a single membership covers all members of the household for the same price. The second is Section 3, the membership and payment options. Monthly memberships are only $9 a month, and an annual membership is $85 or $65 for seniors, which is anyone over 60 years of age. I've also highlighted a few things in the terms and conditions. First is that the membership ensures the patient will have no out-of-pocket flight expenses if flown by a company providing prepaid protection against a company's air ambulance costs that are not covered by a member's insurance or other benefits or third-party responsibility. Secondly, AMC provider air ambulance services may not be available when requested. Members who have insurance or other benefits that cover the cost of ambulance services are financially liable for the cost of AMCN provider services up to the limit of any such available coverage. In return for payment of the membership fee, the AMCN provider will consider its air ambulance costs that are not covered by any insurance to have been fully prepaid. Neither the company nor Air Medcare Network will be responsible for payment for services provided by another ambulance service. Additionally, there is an express provision regarding Medicaid that some state laws prohibit Medicaid beneficiaries from being offered membership or being accepted into membership programs, and by applying, members certify to the company that they are not Medicaid beneficiaries. I also want to point out what is not in the application in terms and conditions. Any restriction on the number of transports, request for any medical information, a request for any insurance information. This means that every member of a member's household can receive unlimited life or limb-saving air transport for as little as $9 per month. whether the member is more likely to require transport based on a medical condition or has insurance that could reimburse AMCN for its actual cost of transport. GMR has an average of 2.5 household members per membership agreement currently. I'd also like to address some misperceptions or misinformation regarding membership plans, including the mistaken notion that more in-network agreements with insurers and/or elimination of balance billing is better for consumers than a membership agreement. And to have
We can't hear you. You might be having some technical.
Sorry.
Okay, there you go. I can
All
see
right.
you now.
But any solution to balance billing or in-network won't solve the high deductibles and copays that many consumers face. 81% of health plans contain deductibles, 24% of them are high deductibles. According to the Kaiser Family Foundation in their 2019 employer health benefit survey, there's been a 36% increase in deductibles in the last 5 years and a 100% increase in the last 10 years. And with respect to deductibles and copays, there's also an argument that these deductibles and copays exist as a means to discourage overutilization and should not be routinely forgiven or waived. In my experience, this is a concept more common in property and casualty insurance and is intended by insurers to avoid the administrative expense of low-dollar claims. And I'm not exactly sure how life or limb-saving air ambulance services dispatched by a third party could be overutilized by a consumer, but I also disagree with the premise. Deductible buyback policies are available for various insurance products. There's also a statement made earlier that that many members will delay their care in order to ensure that they're transported by a provider that is covered in their membership agreement. Not aware of any evidence of that. Often these dispatches are, patients are not even conscious. They're not able to make that decision. And I also, there was also a reference to cancellation of policies, and I'm not sure exactly what that refers to, but once the membership fee is paid, GMR's contracts are not cancelable. Another misperception is that a Medicare enrollee does not need a membership plan because Medicare covers air ambulance services. This is only true if the enrollee has purchased Medicare Part B. And there is still a 20% copay under Part B, which based on Medicare's average payment for air ambulance services averages $1,391, which is 21 times the $65 membership fee for seniors. It is possible that a Medicare supplement policy could cover this copay, and AMCN includes an FAQ on its website advising consumers to check their coverage. It is also the case that Medicare has a very strict view of medical necessity and has a higher rate of denial for air ambulance services based on that medical necessity, in which event a Medicare supplement policy would not provide coverage. Additionally, several Health and Human Services Office of Inspector General advisory opinions have held that membership subscription agreements are permissible for Medicare enrollees under certain circumstances. We believe that AMCN's membership programs provide enormous benefits with little to no downside to consumers. If a consumer is transported by a third party, his or her membership benefit does not apply, and he or she is not disadvantaged because of the membership agreement beyond the membership fee. If a member is transported by AMCN and is insured, AMCN pursues payment of the reasonable cost of the transport from the member's insurer only and accepts the ultimate payment by that insurer as full and final payment for its services. the member will never receive a balance bill. Moreover, AMCN waives payment of the member's deductible or copay, which would be far more than the cost of membership. If a member is uninsured, the entire transport is covered by the membership agreement. The proposed Model Act seeks to categorize air ambulance membership subscription agreements as contracts of insurance and to regulate air ambulance companies that provide services through membership programs as insurers. You've already heard the definition under Black's Law Dictionary of insurance as a contract by which one party, the insurer, undertakes to indemnify another party, the insured, against risk of loss, damage, or liability arising from the occurrence of some specified contingency. AMCN is not indemnifying the member with respect to the specified contingency, i.e. that the member will need emergency air ambulance services and that AMCN will be dispatched and is able to provide such services. Rather, it agrees to provide such service through one of its participating providers if available. If AMCN is not dispatched or an AMCN participating provider is not available, AMCN has no further obligation under the agreement, and AMCN expressly has no liability whatsoever for services provided through another air ambulance service. In the event that the risk of loss, the damage, or the liability arising from the occurrence of some specified contingency is interpreted as a protection against the risk of a catastrophic billing for the use of an air ambulance, AMCN would be the entity sending the catastrophic billing, which never happens to a member, and AMCN would then be indemnifying the member against AMCN.
Ms. Kitzman, I'm going to ask
Yes.
if you could please make some conclusionary remarks. So we have some people waiting to ask questions.
Sure. I believe that in the previous presentation or an earlier presentation, there was a reference to Judge Hovland in some North Dakota litigation who found that subscription products were a form of insurance. He also stated that it was unclear why North Dakota has chosen to prohibit the practice when there is a clear need to address the affordability of air ambulance services, implying that he thought subscription agreements did address the affordability issue. He also noted that Montana had taken the opposite approach, as had Washington, Arizona, and Georgia. Several states do regulate membership subscription agreements as insurance, and there's a range of approaches as to how they do that. Alaska, Nebraska, California take a very light touch. Others have effectively or expressly regulated subscription agreements out of existence. I'm not here to argue the legalities of it, other than to say that we don't think that it is insurance, and also to say that just because a practice may be a form of insurance doesn't mean that it should be regulated as insurance. And I think one of the best examples would be like warranty products, which seem like insurance in that there is a payment in advance based upon a promise to pay in the future for an event that may or may not occur. Florida and a few other states regulate this as insurance, but most, do not. My goal here today, though, was to provide a broader real-world context for membership agreements, illustrate the tremendous value of these agreements, and then to clear up some misinformation about them. Membership agreements may not be the whole solution to affordability of air ambulance services, but they seem to be a good approach until a better complete solution is found, which no one seems to have done yet. Thank you.
Thank you, Ms. Kitzman. I just have a quick question, and maybe Commissioner Mulready could answer this, and then we're going to Representative Lewis. Have there been any cases in any of the state's attorneys generals where that they have filed suit against any of these companies for falsely selling products that they couldn't deliver?
I am not aware of that, but really not qualified to answer that. Sorry.
Okay. Chris, do you know if that's the case? I think I had asked this question before. If people are out there selling something that obviously that there's no one to answer the phone, or even, a benefit to be delivered. Do you know if there's any updated status on that?
I do not know the update of that. That Heli-Medic company just popped up in the last couple of weeks, so probably has not been time for that to be investigated.
Okay, Representative Lewis, you're up.
Thank you, Madam Chair. Just kind of had a question for Mrs. Kitzman. Being in Eastern Kentucky and you know, the rural mountains here and accessibility often being an issue, subscription services to air medical programs is quite common in my area. For some, I mean, it's a high Medicare population here. Being in pharmacy, I see it every day. And the like Mrs. Kitzman, you highlighted earlier that the 20%. I know several people who have been hit with bills, and as such, you know, subscriptions are quite popular here. I guess my question is, do you see these subscription services closer to maybe like an Amazon? And I guess the question boils down on the regulation side. You don't think they should be, you touched on it some, but you don't think they should be regulated as like a supplemental insurance, correct?
We don't think that it is insurance, and then it should not be regulated as insurance. But as I mentioned, there are some states that that do consider it insurance, and there's a whole range of approaches to how it is regulated.
Okay.
What states?
Representative, you're something wrong with your internet. Maybe you're frozen. Well, let's go to Representative Gooch, please.
Thank you, Madam Chair. This is Jim Gooch from Kentucky. For Ms. Kitzman, thank you for your presentation. Some very good, interesting information. My question to you, though, is what percentage of your membership are Medicaid and Medicare recipients?
None are Medicaid unless they, you know, have not told us that they are. I mean, we do include in the terms and conditions that by submitting the application for membership that they are representing that they are not a Medicaid, you know, recipient. So the answer should be, you know, none. I apologize, but I do not know the percentage of the members who are Medicare beneficiaries, but I can get that information and will report that back.
Thank you.
Thank you, Madam Chair.
Thank you, Representative. For any of the questions that were posed today that there needs to be follow-up, we can make sure that Representative Oliverson and Delegate Westfall could make sure that they put this on their to-do list to address the model going forward. So we have concluded our time today. I appreciate everyone's patience, everyone's cooperation and collaboration and participation in this committee meeting today. Can I get a motion to adjourn, please?
Move to adjourn.
Second.
Second.
All in favor?
Aye.
Thank you so very much, everyone. We will see you at our next committee meeting in March.
I'd like to call to order the Financial Services and Multi-Lines Committee meeting for NCOIL's annual meeting here in Tampa. First, are there any legislators on Zoom who would like to identify themselves?
Assemblyman Ken Cooley's here.
George Kaiser.
Representative Derek.
Senator Matt Lester is here.
Anyone else?
Assemblyman Cahill is here.
Joe Schmidt from Washington is here.
All right. Do we have any legislators in the room in Tampa, Will?
Martin Carbaugh, Indiana.
Matt Lehman, Indiana.
Senator Andy Zay, Indiana.
Senator Vita, North Dakota.
All right. We got the Hoosier delegation and one from North Dakota. Welcome, gentlemen.
Representative
be
Jim
in the
Gooch is
South.
here.
Mike Weber, State of Michigan.
And Peggy Mayfield from Indiana.
All right. Anyone else?
Jim Gooch from Kentucky.
Good to see you, Jim. All right. Can I ask for a motion to waive the quorum? Can I get that motion?
So move.
So moved.
Second, all right, we got that. Can I get a voice vote? All in favor by the usual sign of aye?
Aye.
Any opposed? Ayes have it. I also need a motion to adopt the September 26, 2020 committee meeting minutes. Can I get a
So
motion?
move. Move adoption.
Thank you, Mr. Solomon Cooley. We got a motion and a second. All in favor?
Aye.
I got ayes. Any opposed? Well, I think the ayes have it. At this point, I'm going to turn it over to Senator Lesser. Oh, I think he has a few brief words about his model.
Yes, thank you, Mr. Chairman. And Mr. Chairman, I think like you, I regret not being able to be poolside in Tampa today, but appreciate the opportunity to be with folks anyway. We had a good initial discussion of this model, which starts on page 127 in the legislative binders at the last meeting in Old Town. Since that time, I know there has been discussion about potentially replacing the model with Colorado House Bill 1091, which is in your binders on page 141, to address some of the concerns we heard from interested parties. At this time, I would rather make some amendments to the existing model as opposed to replacing it. For example, I think we could get to a place where perhaps we include some drafting notes in the model on issues such as requiring an independent expert and holding a public hearing so that states can have options as to whether or not they want to require those things in their statutes or to provide their commissioner with discretion. And that's a way to indicate that we've considered these as important conversations while recognizing there is an ongoing disagreement. I look forward to working on the model after this meeting, and hopefully it would be ready for a vote at either our next meeting in March or our July meeting. And thank you, Mr. Chairman. I'll turn it back over to you.
Thank you so much. I think the first interested person we have to speak on our topic is going to be Karen Meltrick with ACLI.
Meltrick, thank you very much, Mr. Chairman, and good pronunciation.
I try my best, Karen. Thank you so much.
Sometimes I get Melcher too, you know, the French side of it, but it's actually German. So, well, good afternoon, everyone. And I look forward to being with you all in person again. I wouldn't have minded being in Tampa either and seeing all of your lovely faces. My liver, however, appreciates not being with everybody for an extended period of time for the after party. But anyhow, we really do appreciate the opportunity to speak to you this afternoon. And I appreciate Senator Lesser's statements on this being a work in progress. I'm just going to reiterate a couple of things before I turn it over to my colleague, Paul Martin from the Reinsurance Association of America, on why we suggested Colorado as a replacement. And I understand perhaps not wanting to replace the model as it is, but we think that's actually a cleaner approach to this, because as I stated in September, the Colorado bill is based on the Illinois bill, which was actually based on the Connecticut bill. And there have been improvements along the way. And we as ACLI and RAA worked with interested parties in Colorado to get that bill to a point where we were supportive. And we would like a model here at NCOIL that we could be supportive of. And we recognize that there are some differences. I know there's an issue surrounding the independent expert, and I think we can work on possibly addressing it that way. But when this issue first came to light back in 2017, when Connecticut adopted their model, the industry was pretty divided, and we as an association were not really able to weigh in on any current proposal at the time. We've worked over the last couple of years to get to a point where we had principles and guidelines, and that is what based our suggested revisions in Colorado, which were adopted and would have moved forward, but for COVID ending their session prematurely. So we would like a strong model from NCOIL, and we think that the Colorado bill as amended is a great place to start in addressing some of the concerns that Senator Lesser has raised from his own state's Department of Insurance. And we look forward to continuing the dialogue in the interim and hopefully getting to that point by March. So we do have a strong model that we can stand up and raise when we face this issue in other states, as it is popping up a lot in states as we go around, as an important tool for insurers to be able to organize their risk portfolio and create their corporate structure. So that's all I have to say today. I'm happy to answer any questions, but I think Mr. Martin was also going to add some to that.
Well, Paul, before you go, I want to recognize Assemblyman Cooley. I think he may have a few comments, and then we'll go on to Mr. Martin.
Thank you.
Thank you very much, Mr. Chairman. Get my voice back online. Yeah, I actually think this is a very important model. And I've been talking with Senator Lesser. I sort of look at his bill. I feel like I often feel when I sit down to draft a bill, and I've done that a lot in my career. My starting point is always, I like the way I'm doing it wrong, better than the way the other person is doing it not at all. I think this is a good model to start with, but I do understand how as ideas get examined as you go through time, you start seeing possible issues, and we kind of go through this iteration of just knocking the burrs off, cleaning up models. Somebody has the burden of getting that going. I strongly favor the idea of this is now NCOIL. This is state lawmakers talking. What do lawmakers come into the various states in this area? I think we are the ones who safeguard the public trust and interest. I feel that these types of divisions are actually highly technical, and it is for the good of the order, good of the public, I think, to have a provision for a hearing. I don't favor a court hearing, a regulatory hearing. It may be de minimis. They may decide that it's pretty perfunctory, but they have to put together a record, an analysis, something there, an opportunity for someone to speak to if they want. I actually feel that furthers the public interest. For the same reason, I sort of feel like a drafting note that addresses having an expert potentially would be a very good drafting note to put in a bill like this. And then I would almost say we might want to backfill it to just include a little authorization for the regulator to hire that expert talent if they go down that trail. So it's like it's implied you would use an expert. They've got the authority to use it. It sort of rounds the deal out. In my experience, my own state regulator, we often have very experienced people in the department. It would not be uncommon, actually, thinking from California standpoint, to have the regulator feel they can handle this in-house. And I would very often believe that, but I sort of think as a legislator, it's our job to kind of lay down what is the framework. I personally feel that we ought to be producing off the platform, off the chassis of this model, a NCOIL model that I think gets embraced around the country. So I actually favor having some allusion to a departmental hearing in the bill, because I think as a public official, I want them to take that step. It exposes their thinking in the public realm before we all have to live with it in headlines of the local paper. And I think acknowledging that they need to make a judgment of whether they have the right talent in-house or not. I do think as lawmakers, it's fair to push the regulator on that issue. And it's not to be a pest. It's just to make sure that if we're going to commend this to the 50 states, We feel we have a good plan. So thank you, Mr. Chairman. Those are my comments. But I am supportive of moving this forward today, subject to the kinds of changes the senator has offered and our ongoing deliberations.
Thank you, Assemblyman. Mr. Morton.
Chairman, members, Paul Martin, Reinsurance Association of America, appreciate the opportunity to address this. And Senator Lesser, thank you for your willingness to visit with us and discuss this moving forward. I fully agree with Assemblyman Cooley's comments. We do think that there are some things in this bill that need to remain. As you folks know from your day job as legislators, as we get better with a particular issue or concept, the legislation tends to get better and better. What we're aiming for in the Colorado model is to take the lessons learned from other states and come up with a model that represents a best-in-class solution for the division issue. The two issues that seem to be causing the most heartburn are, as both the Senator and the Assemblyman pointed out, are the hearing requirement and the expert requirement. I just want to touch very briefly on why we think those are necessary. When we talk about a hearing requirement, we're talking about due process. And due process has basically two concepts, two parts: notice and opportunity to be heard. Right now, under the proposed draft model, there's not enough access to information about the potential division or an ability to raise concerns from policyholders. And policyholders could be insurance policyholders, they could be annuity holders, but also reinsurers who have ongoing contractual obligations to these companies. Policyholders, reinsurers may have questions about capitalization adequacy, the proposed leadership of the new entity, or the state of domicile. Could be a whole host of reasons why there should be a hearing to flesh these issues out. And then why is the expert necessary? And I understand that the Connecticut Department of Insurance and the California Department of Insurance has a lot of in-house expertise, and I could appreciate the fact they could say, we know these entities, we are well capable of looking at them and determining whether or not this division model, this proposed division, is a good idea or not. I will tell you that there are some departments out there across the country who may not have those resources. And so we think that's why having that expert, having somebody with the expertise to look at these entities and render an opinion as to whether or not the the division should go forward. Finally, this is probably one of the few times, members, that the industry is going to come to you and say, we think the commissioner or the superintendent or the director of the Department of Insurance should actually have more authority and more discretion. We feel that they should in this situation. Under the current model, under the current proposed model, if a petitioner for division checks all the boxes, the commissioner, the head of the department, must approve the division. We think that the commissioner should have the discretion, after reviewing all the evidence, all the concerns, all the hearing, and have a hearing and hear everyone's opinion, and then make a decision as to whether or not that division needs to go forward, or do some changes need to be made to the proposed division before it is allowed to proceed. We would submit that these are not onerous requirements, but rather enhance the confidence of the public and of the industry in the division process. And we look forward to working with the Senator and the Assemblyman and all the other stakeholders moving forward.
Thank you. All right. About Ms. Dunn. Is Ms. Dunn available?
Yes, I am. Thank you, Mr. Chairman. How are you?
How are you today?
I'm good. My name is Bridget Dunn, and I am head of government affairs for Talcott Resolution. Talcott Resolution is a privately owned insurance company that's based in Connecticut. We were formed in 2018 after the purchase of the Hartford's closed block of life and annuity business. And over the last 2 years, we have been working to manage that closed runoff block of business while actively looking to grow our platform. One of the mechanisms that we hope to utilize in order to acquire other runoff blocks of annuity business is insurer divisions. We're lucky enough to have an existing insurer division in Connecticut, and we believe that more states that have insurer division laws give us a greater opportunity to grow our platform in a more strategic way. I think it's important to note that a division is essentially a reverse merger, and I agree that it needs to have robust Form A-like parameters around it in order to be completed. With that said, it's important that each division follows the Form A process or Form A-like process for each state, which can differ from state to state based off of their holding company act.
I had myself on mute. I apologize.
Yep.
All right. Does that conclude your comments?
We're just encouraged by the conversations that's happening at NCOIL, and we look forward to the future development of this model and hopefully the quick passage of it so that it can be introduced in future legislative sessions. Thank you.
No problem. All right. How about Mr. Daniel Llewellyn? I hope I pronounced that correctly.
You did. Thank you, Representative Jordan. My name is Danny Llewellyn with the law firm of Fagery, Drinker, Biddle, and Reese. I'm here today on behalf of the National Organization of Life and Health Insurance Guarantee Associations, or NOLGA, and the National Conference of Insurance Guarantee Funds, or NCIGF. Thank you for allowing NOLGA and NCIGF to make comments on the proposed insurer division model. Both the NCIGF and NOLGA remain neutral on whether or not insurer division statutes should be adopted. Both also agree that if such statutes are adopted, any insurer division approval should ensure that the eligibility of a dividing insurer's policyholders for guarantee system protection must not be disrupted because of a division. We also appreciate the efforts that have already been made to ensure that a division plan would not result in policyholders losing their eligibility to be covered by the Guarantee Association or Guarantee Fund in their state of residence. We believe that as a matter of core principles, we're aligned. We believe that focusing on addressing two drafting issues can better preserve the principle of guarantee system protection. First, ensuring continuity of guarantee system protection should be mandatory. There needs to be confirmation that there would be no discretionary authority to approve a division plan without satisfying the fundamental policyholder protection concern that none of the dividing insurer's policyholders would lose eligibility for Guarantee Association or Guarantee Fund protection as a result of the division. Excuse me. The current draft identifies generally that the continuation of such protection is one of the three requirements that, if satisfied, mandates approval of division. It does not, however, make it clear that discretionary approval is not permitted where this policyholder protection standard for mandatory approval has not been satisfied. Second, the division sponsor should demonstrate continuity of guarantee system protection in the plan of division. In order to ensure that this standard is addressed meaningfully in the insurer division review process, it must be incumbent on a sponsor of a division plan to include in the division plan some evidence or basis that the division will not result in any policyholders losing their eligibility for Guarantee Association or Guarantee Fund coverage. Following this meeting, NOLGA and NCIGF will offer specific language suggestions to address these issues, including any criteria that should be addressed in a division plan to establish that continued eligibility for guarantee system protection will not be jeopardized by an insurer division. Again, we appreciate the time this afternoon to provide these points to the committee. Finally, a special hello to the strong Hoosier delegation down in Tampa. I assume the weather down there is slightly better than it is here in Indianapolis. That's all. Thank you. Representative Jordan, I think you're on mute.
All right. I think they unmuted me now. All right, great. If we don't have any other discussion from any of the legislators at this time, we'll move on to the next discussion. And that'll be the COVID-19 Insurance Modernization Act and initiatives. And so we have an update by Commissioner Glenn Mulready from Oklahoma. Is he available?
He's walking right up, Mr. Chairman, running right up.
That's all right. Tell him to take his time. No need to run.
I'm here. Sorry about that.
Thank you, Commissioner. How are you today?
I'm doing great. Can you hear me okay?
You're just great. Just fine.
We good to go?
You are good. You're on.
Okay. Well, Innovation Technology Task Force update. And Representative Lehman is not here, which is really unfortunate because we have lots of accolades for him in that work. The Innovation Technology Task Force met virtually last Friday during the NAIC's fall national meeting. The task force updated the anti-rebating amendments to Section 4H of the NAIC Unfair Trade Practices Model Act, model number 880, with 2 minor revisions. The task force appreciates Representative Lehman's participation, good he is here now, and many contributions to these amendments. We feel these revisions strike the right balance in allowing companies to utilize new technologies to offer value-added products and services that mitigate risk and better serve consumers while ensuring appropriate consumer protections. The task force also heard an update from Representative Lehman on NCOIL's insurance modernization activities. We look forward to continuing to work with NCOIL and all state legislators on issues and legislation related to innovation and technology. We appreciate your efforts in this space. Thank you very much, Representative Lehman. The task force also discussed responses from interested parties to its request for information related to continuing specific regulatory relief or regulatory accommodations offered by states related to technology and digitalization as a result of the COVID-19 pandemic. 9 responses were received. The task force summarized them in a document that's available on our website. The summary includes response tables grouping the comments into 4 main categories, including which organizations offered a similar or same suggestion. The tables cover the following areas: electronic commerce, regulatory capabilities, claims facilitation, specifics to surplus lines. While most did not include the specific statutes or statutory language they recommend eliminating or revising, the task force did receive a specific recommendation to develop a bulletin to address concerns relating to existing legislation and or issues related to the state-by-state implementation of e-signature laws, including the Uniform Electronic Transactions Act and existing obstacles to moving e-commerce forward. Task force members are now in the process of determining which issues to prioritize in the 2021 work plan. I want to also note that the task force has combined our big data and artificial intelligence working groups to create synergy and efficiencies, as the use of big data and intelligent algorithms by the industry are so intertwined, it just makes sense to combine those 2 groups. That was done on Friday as well. The task force plans to move forward in 2021 with developing a regulatory framework or strategy for reasonably and meaningfully overseeing and monitoring industry's use of big data and intelligent algorithms like AI and machine learning. The task force may start by looking at the development of a corporate governance model or guidance consistent with the intent and expectations of the AI principles. We look forward to continuing to work with NCOIL on these important initiatives. And again, thank you, Representative Lehman, for all your help on our behalf.
Thank you, Commissioner. Representative Lehman, do you have any comments to add?
No, I just, it was always a pleasure to work with that group, and it's a very receptive group, and I think we got a lot accomplished, and looking forward to continuing our work with the NAIC.
All right, well, thank you so much. Thank you for your hard work on this, Commissioner. All right, we'll now move on to producer licensing and Wes Bissett.
Thank you, Mr. Chairman. Can you hear me okay?
I can hear you just fine. Thank you.
Right. Very good. Very good. Thank you. I'm Wes Bissett. I'm Senior Counsel of Government Affairs for the Independent Insurance Agents and Brokers of America. I appreciate having a quick moment or a few minutes maybe to talk about how the COVID-19 pandemic, how it affected the agent and broker credentialing process at the state level. That's things like what agents need to do to obtain and renew licenses and what they need to do to maintain those by completing continuing education. I think it's safe to say that the regulatory framework for credentialing and many other things underwent a fairly significant stress test in recent months, and at least as it relates to agent licensing and CE issues, the states did very well from our perspective. They deserve a lot of credit, both legislators and regulators, for how things played out. And the success I attribute to 2 things. First is we had a very strong statutory framework in place. And so the statutory framework, which is based in large part on the NAIC's producer licensing model law, which has been broadly adopted by many states, most states, is flexible and gave regulators the sort of the authority that they needed to act on some of these issues. That was critically important. Second, and maybe even more important, was that over the last 2 decades, all industry stakeholders, legislators, regulators, the industry have been working in concert to create an online platform, if you will, that allows agents to satisfy these types of administrative requirements, like renewing a license, to be able to do that electronically. And so all that investment of resources and hard work over the last 20 years really paid off during the pandemic. I'm going to talk briefly about the impacts of COVID on both existing licensees and then on people trying to get into the industry. Our focus was largely on those existing licensees who already have existing customers, and less so on people who were new, attempting to get in for the first time. And if you were an existing insurance agent, there were a couple of potential questions that might have come to mind. If you renew a license pretty quickly, how would you do that in a COVID environment? And then on a related note, if you had to comply with those education requirements, which many people do in person, how would you do that? And what states did, there were 33 states that issued bulletins that provided extensions of time for agents to comply with their renewal and CE requirements, and that was helpful. In some ways, though, that might not have even been necessary because of the work that's been done over the last 20 years. Agents in most states now can renew licenses online, can comply with most of their CE online. And so while it was nice to have that flexibility, a little bit of breathing room in a very difficult environment to comply with those requirements, they arguably were not especially necessary. And my phone was really not, it was ringing off the hook in the spring, but not from agents, existing members who were raising questions and concerns about renewals of licenses. A bigger issue was that universe of people who were not in the industry now and trying to get licensed for the first time. And the hurdles that they were facing were an inability to pass an exam, which you need to do in order to be licensed for the first time, because you couldn't go to an in-person site and take the exam. And then secondly, their inability to undergo a criminal background check, another prerequisite, because they need to give their fingerprints to regulators in order for that to happen. The good news is that there as well, the state regulatory frameworks had already anticipated this. There's a provision in just about every state code that allows for temporary licensing, and states under the NAIC model and laws in most jurisdictions can issue temporary licenses of up to 180 days. Commissioners have a lot of discretion when they do that. They can condition and impose special requirements on anybody getting such a license. And one of the features of that is that if you're getting a temporary license, you have to have a sponsor, either a licensed agent or a licensed company that's prepared to assume full responsibility for the actions of that temporary licensee. And I know there were some in the industry who were pushing further for states to issue full-blown licenses to new applicants during the process, but the temporary licensing system, in our view, worked well, and there were 30 states that took advantage of that. One other development, I know Karen's going to talk about this in a little more detail, is that we're already seeing states sort of obviate the need for temporary licensing because they're already beginning to offer online examinations to new applicants. And in less than a year since the outbreak of COVID, there have been 26 states that now offer online exams that didn't at the beginning of this year, and there are more states on the way. States have the legislative authority to do this. The NAIC model that I talked about gives regulators the ability to issue rules, contract with vendors, et cetera. And according to the NAIC, checking with them this morning, they're not aware of any state where there's a statutory impediment to online licensing. There may be some regulatory impediments. So from a legislative perspective and talking about these issues, we don't see at the Big I a need for significant or sweeping legislation or a new model law related to credentialing. We do, though, think that there's an important role for legislators and as it relates to oversight. One of the things that the COVID outbreak has highlighted is the importance of making compliance with these simple administrative tasks, to make that easy and fairly simple, and to maybe look at those issues differently than more substantive ones. So one thing we'd urge you to perhaps consider is there's been an effort over the last recent years, and I mentioned the National Insurance Producer Registry, to kind of create a multi-state system where an agent can go online and renew their licenses in just about every state electronically in one stop. The impediment to that, though, right now is there are a handful of states that NIPR calls the NIPR 5 that don't offer the full functionality of NIPR at the moment, and it's really holding down the opportunities that we have as a sort of a national insurance regulatory system. At the risk of alienating legislators in a couple of states, New York and Washington State are among the jurisdictions in that NIPR 5, but getting all states on board offering these online opportunities would be significantly helpful. We'd also urge legislators to monitor what is happening with this sort of new emergence of online examinations. If there are hiccups and a need for guardrails, there might at some point be a need for legislation. But where we are now, it's really been a success story, largely because of the statutory frameworks that you and your predecessors put in place. But as events warrant and things may change, we certainly won't be reluctant to come back to you, maybe with recommendations for potential legislative action. Thank you, Mr. Chairman.
Thank you. And we look forward to it, Wes. I appreciate it. All right, Karen, I think you're back up again.
Good afternoon again, Mr. Chairman. Thank you very much. I'm Karen Melchert with the American Council of Life Insurers, which I neglected to note when I spoke a few minutes ago, so apologize for that. And thank you, Wes. He touched on most of the issues that I was going to touch on. We share a similar viewpoint here. Temporary licenses really were a godsend during the pandemic because, as Wes pointed out, when there were shutdowns, people couldn't even go to the facilities because they were closed. They weren't necessarily deemed as an essential business, although insurance had been. And then when the lockdowns kind of loosened up and people were able to go back out, social distancing restrictions and indoor limitations were still in place, which meant that you had less capacity at these testing centers, and you had a backlog of tests that hadn't been able to be taken for the last couple of months. Plus, in Illinois, for example, Pearson VUE is our testing company that does tests for all professional licenses, not just insurance agents. So you add to the backlog of just the insurance agents, you add all the other professional licenses that need to be taken, the tests taken. And currently they're working on online testing, but we don't have online testing in all states. At our count, we have 23 states right now that have implemented online testing. And 4 of these also have continued to provide temporary licensing, which, as Wes pointed out, there's a great framework out there that provides for usually a lasting 180-day period of time. And no one wants these temporary licenses to go on indefinitely. That's not our goal. But what we were faced with is, even though we had those temporary licenses, and some were for 90 days, some were for 120 days, some were 180 days, some were to the end of the declaration of the emergency situation. That's all well and good, except for when you run into the backlog of the testing centers. So that's when we've kind of switched gears to trying to get more states on board for the online testing. And so, although to Wes's point, we don't really see a need for any legislative action here in terms of a model law or something like that, I do encourage you to go back to your states and talk to your state insurance departments and see what they need in order to implement online testing. Sometimes it's contractual issues. You have to get a new contract with your vendor, and then that takes time because that has to go through the administrative process with the government. So that would be something we would focus on. The other issue we're running into now, even when we get to the online testing, is really the processing of fingerprints and the background check. So when you get to that point, there are states that will not issue the license until they get the fingerprint report back from the FBI, and we're seeing that delayed 5 to 6+ weeks at a time. So they've taken the exam, they've passed the exam, they've got a sponsoring insurer, they're all set and ready to go. We've done the background checks ourselves. They just had to do the fingerprint check. So I think it would be helpful to look into something along the lines of, what's the word I'm looking for? Provisional, thank you, provisional license in between. That's the step further than the temporary, but not quite, and something that could automatically then become a permanent license once that background check from the FBI came back. So that's something to consider maybe for future action. I don't know what the impediments to that would be legally, or if that's permitted under the current structure, but something that we would think would be worthwhile to look into in connection. Hopefully this never becomes an issue again and we're not in lockdown and restricted in this way in the future, but these are all things that don't really need to happen anymore. We don't need to be in a classroom to take an online exam. I mean, we've got universities that give degrees without ever stepping foot in a classroom. So I think we can kind of switch to that going forward. That is part of the modernization movement. And so you know that this is not a small issue for us. For example, just two of our companies, for example, at somewhere throughout the start of the pandemic till now, had 1,587 temporary licenses, and another one had over 1,000 temporary licenses. So these are jobs. These are people who are trying to start a career as an insurance agent. And when that is delayed, and sometimes they will back away from that and maybe not follow through on it. And then the money and time that the company and the individual have put into getting to this stage is disrupted. And then we don't have the bench strength, if you will, as we bring in new young talent, and also the ability to get into more communities and really disseminate our product in a more broad format. So we really do appreciate all the support we've gotten both from the regulators and the legislators in our efforts to do the temporary licensing and the online testing and the online learning, which was something that Wes pointed on. So we just wanted to say we appreciate the support for that and the consideration, and just to keep those things in mind, particularly as you go back to your own states to see where they may be in that process and what you can do to help them move that along. So thank you very much. I appreciate the time.
No, thank you. I appreciate it. We have any comments from any legislators? Any experiences you may have in your own states? All right. If none, we'll move on to remote notarization and Mr. Frank O'Brien.
Thank you, Mr. Chairman. Good afternoon, everyone. Thank you for allowing me to join you remotely. I too look forward to the day when we can have an in-person meeting. And I do note that the summer NCOIL meeting is scheduled for Boston, my hometown. So I look forward to hosting all of you fine folks at some point in time. First round's on May. In terms of notarization requirements, this is one of those issues that we just kind of dealt with. It wasn't an issue until it became an issue. It's sort of something that we've always had to do. Every once in a while, you all have to get stuff that has to be notarized, etc. And so that has to be dealt with. Social distancing requirements, the pandemic in general, not wanting to be around folks, brought to a head some of the issues that we've been facing from an efficiency point of view for some years. Eliminating in-person notarization requirements and giving businesses the ability to remotely notarize certain things was a significant relaxation during the course of the pandemic, and about 36 states passed guidance, orders, issued bulletins, etc. As you might expect, however, with so many states doing things in so many different ways, folks were kind of all over the place. We think this is an opportunity for NCOIL to step in, particularly within the insurance space, because NCOIL is the Insurance Legislators Association, to step into this space, take a look at where notarization adds value, where notarization provides a measure of consumer protection, and perhaps where it is a requirement or a procedure that has outlived its usefulness. In addition, we think that it is a good use of NCOIL's time to take a look at should online notarization be utilized. We're able to meet virtually via Zoom. We're able to get licensed or hope to get licensed, certainly get degrees in a virtual setting. So why can't some of these consumer protection requirements be done virtually as well. One of the things that has happened over the course of the past several months, and the Commissioner for Oklahoma and NCOIL's president have noted it, is the ability of both NCOIL and the NAIC to come together to hash out models and changes that provide a good balance of consumer protection as well as efficiency. And APCIA believes that remote notarization is one of those areas. And we look forward to having this remain on NCOIL's agenda for the coming year, working with you, Mr. Chairman, and the committee on this issue. And with that, I'd be happy to answer any questions.
Thank you, Frank. Do we have any questions out there? Well, look, I will tell you, I certainly look forward to working with you on this. One of the issues we have here in Louisiana, we did pass a bill and we have an executive order from the government, from the governor. But the one of the concerns that I have with our bill here in Louisiana and the order is that it requires you to retain the records for 10 years, which is really, as an attorney, which is longer than the bar requires you to retain records. You only have to retain them 7 years after the conclusion of a matter, but on a remote notarization, you have to retain it for 10. So I would at least hope that whatever model we pass, that it complies with whatever the state requirement is. I mean, if a state has a 10-year retention policy, then so be it. But if a state has a 7-year retention policy like we have, that it would sort of model that and stay in line with it so we could have some uniformity.
Mr. Chairman, I want to echo your thoughts, and I would also want to point out that this particular model could have potentially have a really cool nickname. We could call it the remotery model.
Let's work on that and see where we go. Do we have any other comments from any other legislators out there today?
Mr. Chairman, I do have this is Representative Lehman. I do have a comment. I think it's interesting that when this whole COVID thing began, I think a lot of us started to hear the term, we hope new things come out and we never go back to doing it the way we used to. And I think through technology and everything else, the two issues we've just talked about, remote notarization and producer licensing, are two things I'm glad to see continue to move forward, because I don't want to go back to how we used to do it, because I think these are the much better ways moving forward. And so I applaud you, Mr. Chairman, for keeping these going, and we'll look forward to additional developments over the next couple of months.
Well, look, I look forward to continuing to work again, and hopefully we can all meet in person in March and deal with this. Do we have any other business?
Mr. Chairman?
Yes.
This is Representative Kaiser. Just a comment, much following Matt Lehman's comment, the pandemic really provided an opportunity for all industries, but especially for the insurance industry. We were able to respond in amazing ways. Temporary licensing is one great example. However, it's not where we want to be. We do not want temporary licensing as a standard, because there's a great value in going through the full licensing process and protecting consumers. We need work at all levels, and what we should be working towards is those things which we had to do out of necessity that we shouldn't really want to do can be eliminated by action at this time. I know many states have gone to online training. They've gone to online testing. So that issue has been eliminated for some states. Licensing, we're getting to online. Many states still are having a problem with electronic signatures. And states, legislators need to look at their legislation relative to electronic signatures and how they may be causing some problems in things like licensing, that sort of thing. The federal government needs to look at this. The FBI has to come up with an alternative for getting fingerprinting done in a more reasonable time frame than just to say, well, it's the pandemic, we can't do it. This meeting is a demonstration of one of the reactions. I know we're a very small state, but within about 2 months of the onset of the pandemic, this was our mode of operation in our state. You wanted to talk to anybody in the department, you could. You went right online and you were the public was there. If they didn't have the capacity to do that, we worked with them to get that capacity. So we need to take the lessons learned from this pandemic and find solutions rather than say, okay, if another one happens, we'll go back to temporary licensing, because it is not the best solution for our consumers.
Well, I certainly will agree with you and echo some of your comments. We've had some of the same issues, not really as it relates to insurance licensing, but we just regulated hemp here in Louisiana a couple of years ago. And you have to go through the background check through state police and the fingerprints. And we've had some of those same delays, but different industry, but same issue. So I certainly understand where you are. I can tell you as it relates to remote notarization, a lot of our bankers and financial institutions wanted that, because I don't know how it is in your state, but in Louisiana, a notary is sort of a dying breed right now. So, so we're looking at ways to someone else's point. I think to Frank's point, not everything maybe needs to be notarized. So, so we're even looking at those processes as well. So, again, I look forward to continuing the good work on it. I think we need to look at all these approaches. I agree with you. Temporary licensing is not the way, but I think from any crisis comes opportunity and innovation, and this is one of them. So let's keep our thinking caps on and keep being innovative in this area. All right. Any other comments? All right. Do we have any other business? All right. If there's no other business, can I get a motion to adjourn?
So move.
So second.
Thank you, Senator Makuda. All right. Well, look, I certainly hope to see you guys at the next meeting. If you haven't heard, Louisiana, we are clearly in a third wave now. So I would, until I see you guys, have a safe holiday and be safe until we can see each other in March.